And that's precisely what brings us to today's topic, SIPs, systematic investment plans, because systematic investment plans have proven to be a convenient, disciplined, periodic, and prudent path to wealth creation over the long term. And here at the Bombay Stock Exchange on iconic Dalal Street, we thought it'd be especially appropriate to take the day to put the spotlight on this preferred investment vehicle and make the case for why SIPs belong in your portfolio. Now, it's worth mentioning that as an initiative, SIP Day, now in its second edition, has already become a platform that brings together people from all walks of life, for whom ushering in an era of financial freedom is deeply personal and highly pivotal. And we'll give you a glimpse of how. Have a look.
Kotak SIP Day, a mega investor education initiative, continues its mission to empower every Indian with financial freedom. People from different walks of life who are not financially savvy or are always putting their life on the line, SIP Day became a crucial awareness platform for them. This year, 4 ground cluster events were conducted keeping the audience in mind, targeting Ganpati Murtikas, Amul Dairy, Railway Protection Force and Chandni Chowk merchants and traders.
And when you do something for the people who are backbone of this system, you feel so good and you feel so satisfied, and most of them, they were knowing little bit, but methods and few things which I taught them today, they were not even aware of. So I'm feeling very, very happy.
Each of these groups featured a mix of individuals who had some knowledge about the investing but were not thorough enough.
Definitely this was a very good seminar.
अपनी बचत से ज़्यादा लाभ लेने के लिए म्यूचुअल फंड को इस्तेमाल किया जाए।
मेरा सपना है मैं अपना एक घर बनाऊं, तो उसके लिए मैं जितना बचा सकती हूं उसके लिए उतना बचाऊंगी।
सपना बहुत है, सपना पूरा होने के लिए कोई जरिया चाहिए, जस्ट लाइक SIP।
किसी की भी बात नहीं सुनेगा, ये SIP में सबको डालो।
These cluster events became the one-stop interactive platform for them to understand SIPs and the best possible places to invest in order to secure their future.
A huge round of applause, ladies and gentlemen, for this groundbreaking initiative. And as we formally kick off the day, we encourage you to capture key takeaways from this afternoon's session by leveraging social media using hashtag SIPDay. You're most welcome to also pop into our photo booth towards my left to collect a special personalized SIP Day memento. And we'll also be streaming live on both Kotak Mutual Fund and ET Now's YouTube channels throughout the day. Now, before we proceed any further, simply to put everything into context, we wanted to kick things off with a focused dialogue, a dialogue that discusses the country's current market climate and then do some looking inwards and some introspection on our personal investment mindset. To help us do exactly that, may I please invite on stage the Managing Director of Kotak Mutual Fund, Nilesh Shah, and ET Now's Executive Editor, Nikunj Dalmia. Huge round of applause, please.
Well, it's time to say a formal good morning, I guess, right? Doesn't sound like Sensex at 30,000 when we get such a low response. Good morning. Yes. See, the SIP culture is helping. So, little bit of backdrop here. This is the season 2 of SIP Day, and we're very proud to share with you exactly a year ago when we kicked off SIP Day season 1. Kotak Mutual Fund set a record, and that record is 30,000 SIPs were registered because of SIP Day. Are we looking at beating that record?
Yes, partly market is helping, partly ET Now is helping, and partly we are working hard. So this time the response is fairly encouraging. And more importantly, we are looking forward to bring those set of investors who haven't yet invested in mutual fund. So it's not only the SIPs from the regular customer, which we could get, otherwise also, but the focus is to bring that segment of society which has not yet invested in capital markets, equity markets, which haven't yet witnessed the magic of compounding on their portfolio. So we are very hopeful for this SIP day.
Okay. So how many of you have a registered SIP right now? Please raise your hands. Okay, so that's not even 15%. So Nilesh bhai, I'm hoping that we'll be able to have some converts from here, and I'm sure we'll be able to beat last year's number.
Definitely, we'll be looking forward to it.
You know, I was not expecting such a poor response, to be very frank. You know, I thought that at least 50 to 60% of the audience would be participating in the SIP. So I hate to start with a very basic question, but what is a SIP? Because if 85% of the audience here is not actively investing by the SIP route, why don't you take a minute and explain them how SIP works and why it should be part of everyone's portfolio?
Sure. So I'm sure all of you have either sat on a roller coaster or you have seen how roller coaster works. Equity market is like roller coaster. If you start on a particular point, it takes you up, down, up, down, up, down. And if you can sit in that journey, if you can go through that entire journey, when the journey comes to an end, you feel quite happy, you feel quite blessed. Now SIP, in some sense, is that small, plate of metal which protects you during this roller coaster journey. It's a very commonsensical tool of investing regularly in an equity mutual fund. I mean, ideally, you should be making maximum money in stock market if you buy low and sell high. It's very easy to say that one should buy low and sell high, but when you enter market, you realize it's so difficult to execute. In fact, majority of people who have exited stock market have actually bought at high level and sold at low level and then blamed stock market for not giving them enough return. So what we have done for starters, for people who don't have time, for people who don't have energy to focus on their portfolio and investment and market, it's just a discipline of investing on a regular basis some amount. Someday market will be expensive, someday market will be cheap, someday market will be high, someday market will be low. But if you keep on investing over a long period of time, the SIP starts working in your favor. You start benefiting from the volatility of the market. And over 5, 10, 15, 20 years, when you close your SIP to take your money out, you get fairly decent return. So SIP is a very commonsensical tool. It's a step up into the market. In some sense, in the cricketing philosophy, when you start your inning, you should be playing in the V, between mid-on and mid-off. SIP is that V philosophy in capital market. When you're entering, please play straight. And once you become experienced, you can experiment with even reverse sweep.
So, is there a good time, age and amount to start a SIP?
When you have money or when you have knowledge, that's the best time to start SIP, including today. There's no better day than today to start SIP. And what we have seen is that if you start early, you really have benefit of compounding in your favor. But we can't go back into the time machine and start SIP backdated. So today is the best day to start SIP, when you have money or when you have knowledge to start an SIP.
What should be the time horizon for someone who's starting a SIP?
So I could see some college student over here. They should be looking at 35, 40 years because that's the time when they will retire. I could see some elderly gentlemen, and if their desire is to bequeath their estate to next generation, then they can still look at 15, 20 years. So look at SIP from your objective point of view. Is your objective retirement? Take a 40-year call, take a 30-year call, take a 20-year call when you are going to retire. If your objective is to bequest wealth to next generation, then even at elderly age, you'll have to take 15, 20-year view. So link SIP to your investment objective.
So someone at 18 can start a SIP, someone at 81 also can start a SIP.
I mean, I have seen, in most of Indian families, when a kid is born, most of the relatives come and give some money. This is tradition across India. I have seen in many cases, investors using that money which is received on the birth of a child into SIP. I have seen in marriages, when we go, we give chandla. Now that system is going away, but still in some cases you give. That money is also coming into SIP. So you can start for a kid who is born today to the person, till his last day.
Thank God you're not saying that boyfriends have started gifting SIPs to their girlfriends on Valentine's Day.
When one day, Nikunj bhai, that will also happen. Our whole purpose of SIP Day came with Valentine's Day. We saw people celebrating Valentine's Day across the country, even in the Mufusil town. But when we were selling mutual funds way back in early mid-90s, it was very difficult to sell mutual fund. And over 20 years, we have produced returns which is fantastic. Warren Buffett is the god of investment. He is the second richest person. All of us have grown looking at him. And when we compare our gilt fund performance, it is better than Berkshire Hathaway, his holding company, in US dollar terms for last 18 years. So one could not have expected a better return from Indian fund managers than what we have delivered in last 15, 20 years. And despite that, are we being recognized in every nook and corner of India? Answer is no. There are lots of challenges, but we thought if one can popularize concept like Valentine Day, then hopefully the message will reach to every nook and corner of India. And that's how SIP Day came. And I have no doubt in my mind that one day we will see in Valentine Day, instead of selling flowers or chocolates or some other gift, you will be actually giving SIP coupons.
So, father of a bride should ask a prospective boy, "Beta SIP hai na, to beti safe rahegi." Okay, so I want to make this open for the audience. This is all about, you. It is all about SIP. It is all about participating in the India story. And frankly, me and Nilesh were having a chat on the curtain raiser show of SIP Day, and we discussed a very important aspect, which is the power of compounding. And Albert Einstein once said that man's most powerful invention is actually power of compounding. But if Albert Einstein had to write the definition in 2017, I'm sure he would say SIP, because in 1940 SIP was not there.
Yes.
So think about some questions, and while, some questions are coming up. So I want to just make this for the audience. This show is all about you. It's a rare opportunity to, get your answers questioned by Nilesh, so please take maximum, use of that opportunity. Yes, sir, good morning. Please identify yourself. Do you have a SIP?
Pardon?
Do you have a SIP right now?
No, I don't have.
Will you start a SIP after this?
I think I don't need a SIP, but I know about SIP and
Okay.
I understand SIP very
So
well.
why haven't you started?
Because I'm already 65 years old and I feel it's not the right time for starting the SIP.
Okay, Lish, first answer that question before he answers this question. I'm sorry, but I just want to make sure that at 65 also you can start a SIP.
So one, as I mentioned, SIP is like playing Wii. Now, if you are Virendra Sehwag, you can start hitting first ball to a 6. Then you don't have to play in the Wii. But if you are Sunil Gavaskar, then it's better to start playing in the Wii, get yourself in, and then figure out which ball to hit for a 4 and 6. So SIP is a technique. It is suitable for, let's say, uneducated, uninformed, simple common men.
Yeah.
But people who are experienced, people who understand market, of course they can start, without SIP also.
No, I understand, but see, basically for retired person, you need regular sort of income for meeting your expenses. So I feel, there are systematic withdrawal plans and all those things are fine. But I think you can always plan, and I feel it's really not very helping at this stage of career.
Fair point. We appreciate your thought.
Yeah.
Would you like to
Well,
ask a
my question was, Nilesh mentioned about that for equity plan. So SIP is only for equity plan, or it is also valid for debt mutual funds also?
So SIP will work pretty well for equity plan because volatility in equity market is high.
Yeah.
In debt plan, what happens that interest rates do move up and down, but they always move in a kind of pattern. For a while interest rates will go up, for a while they'll come down. It won't go up and down every alternate day, which equity markets can do. So SIP in a debt fund will produce relatively less return, whereas SIP in an equity fund will relatively produce better return. So you can do SIP in debt, nothing wrong with it, but it won't produce as much desired return or as much desired impact vis-a-vis one-time investment, which SIP in equity funds will do.
So what you highlighted about regular investment, so that is as good applicable for debt plans also. So my question is whether AMCs like Kotak, are they really offering right now also SIP in debt mutual funds?
Yes, we have SIP in debt mutual fund, but what happens is that most of the salaried people, when they do SIP, they prefer equity because that debt portion is either invested in bank fixed deposits or provident fund, or some amount of money is going into EMI. So by virtue of that, majority of salaried class SIP is coming into equity rather than in debt. On the other hand, there are businessmen, professionals, entrepreneurs who can invest into both SIP through debt as well as equity. Their bulk of the money actually comes into equity mutual funds because they prefer to make lump sum investment in debt, as their cash flow is not necessarily monthly like a salaried people.
Yeah.
So if I see my SIP book, almost 99% is equity, tax plans, balanced funds, equity funds, and probably 1% is into debt fund, which is more like credit opportunity funds.
Thank you.
Thank you, sir. Any more questions?
My name
So
is
let me ask you a question. Do you have a SIP, sir?
Yeah, I have half a dozen SIPs.
Wonderful.
My name is Praveen Kotbole. And just to inform you, I have 2 SIPs in ELSS plans. So retired people can also have SIPs for tax planning also.
Sir, if you start giving all the solutions, what will happen
No,
to
my
anchors and experts like me?
Anyway, my question.
We are not
We need-
required for third SIP.
We
data.
need word of mouth publicity because I have to always say good thing about SIP, that's my job. But when you talk good things about SIPs, it's your experience.
No, I have a job to protect also.
Yeah, so my question is, mutual funds give returns which are far superior to a life policy. Now with ELSS, they also provide tax relief. And now with SIP, they also provide a avenue to make monthly payments. Now where they fall short is providing protection. Now my question is, why can't a SIP be attached to a TIP, that is term insurance plan? So a portion of the SIP goes toward term insurance plan by way of a group term insurance policy for SIP investors. They can, if you recall, since 1971, Unit Trust of India had introduced a scheme called ULIP. So where an investor had to choose a target amount, let us say 1 lakh, which he pays over a 10-year period, and out of every investment, some portion used to go to insurance cover, and balance used to be invested in stock market. So on those lines, why can't ELSS be attached to a group term insurance plan so that this small shortcoming, which mutual fund doesn't provide vis-a-vis a life insurance policy, can also be incorporated?
Sure. So your suggestion is very valid, and we have example like ULIPs in the past where term insurance and investment both came together. But what has happened over the years is that insurance sector gets regulated by IRDA guidelines, mutual fund gets regulated by SEBI guidelines. And somewhere regulators thought that it is important that insurance industry continues to focus on providing protection, and mutual fund industry continues to provide managing money. They don't want these two functions to get merged, because then a combination of product may not be the ideal from a cost point of view. Over a period of time, regulators have kind of ensured that there is purity in delivery of product or service rather than hybrid. But this is a suggestion which is worth taking up, and we will follow up with regulator if we can provide term insurance along with investment. To some extent, in the insurance industry, that combination is already available by various ULIPs, which is launched by various insurance companies. What we have believed is that if the customer buys a term insurance separately and invests into mutual fund, that combination proves far better. Because today in term insurance, if you go to policybazaar.com, there is a fair amount of range provided by different insurance companies. Similarly, in mutual fund also there is different amount of return which is provided. So if you choose what is best from both, that will give a far better solution than me trying to create that common solution. But your suggestion is good. We'll follow up with regulators to see if it can be cleared.
Sir, group policy will also provide discount in premium. That is the idea. If I buy an
Yes.
individual term insurance plan, it will be more expensive as compared to term insurance.
Definitely.
I just want to take a, and ma'am, good morning. Always lovely to see you for all the events, I'm sure. I just want to take one question from some young audience there. And you're also young, ma'am, don't get me wrong. But just from some young audience there, I wish there was a SIP that time somebody told me. You know, that was my thought, initial thought when I see a young audience. Yes, please.
Exactly. Right now I am in 27 year, and I usually trade in short-term basis and intraday basis also. So what should I expect from SIP? And in fact, what is your message for the youngest people? Like I am 27, and what should I expect from SIP? Because right now around 10 to 15,000 per month I invest in share market, and expectation around 10 to 15% from the share market. So what should I expect from SIP and yearly basis? So please.
पहले तो भैया ET Now देखो, सबसे पहले ET Now देखो, हमारा channel.
देखता हूँ.
So let me first narrate what SIPs will not give you. So you won't have blood pressure, you won't have cholesterol, you won't have diabetes, you won't have back pain with SIP. With traders, all these things will come free. Just, if you don't believe me, go around in this area. There are many broking outfits which do proprietary trading, and just measure the blood pressure of all those people. When market goes up and down, it also fluctuates. See, trading is very, very difficult. I'll give you a story of one of the world's biggest trader called Jesse Livermore. So in 1929, US stock market crashed, and it crashed big time. And you know, most of people lost money when stock market corrected. There was a prominent trader who lost so much money that he didn't return home only. Jesse Livermore was coming home, and his wife was mentally prepared to hear that, look, we have lost our fortune. So when Jesse Livermore entered home, the wife started cajoling him, saying that don't worry, if you have lost fortune, it's okay, I'm still with you. We can always sell this big mansion and move to a smaller house. We can move to suburb. We can rebuild our life. And Jesse Livermore said that, what are you talking about? I have made my biggest fortune in life because I was short the market when everyone was long. And in today's context, he made $1 billion profit. So when everyone else lost, Jesse Livermore made $1 billion in today's context. There can't have been a better trader than this. What happened to him? The guy who was able to make $1 billion when everyone else lost out, just 4 years after 1929, in 1933, went wrong so much on the market that he had to commit suicide. The world's best trader finally ended up committing suicide. A trader is like Shahid Afridi. In a small burst, he can hit any bowler out of the ground. But he can't be Rahul Dravid. He can't be the person whom you can depend upon when it is important to score runs. So trading requires too much of discipline, too much of, onto the ground. It requires a lot of commitment. SIP is for relaxing. You just keep on investing small amounts every month. In bulk of the growing economy, you will see stock market going up. 1,000 Sensex became 10,000, 10,000 became 20,000, 20,000 became 30,000. And in our lifetime, it will continue to grow 40, 50, 60, and eventually 1 lakh if Indian economy continues to grow. So if you believe India will do well, Indian economy will do well, then there is no reason for you to disbelieve that stock market will not do well. And hence, if you keep on investing small sums of money on a regular basis, eventually that will start producing return for you. Trading needs you to be lucky. SIP needs you to be relaxing.
So we're just getting warm up and some more hands are coming up. So what we'll do is that we'll answer a lot of all your questions, let me assure you. But I think it's time also to, change the flow of the event. The next panel will start soon. But I just want to seed some thoughts here. India's GDP, and Nilesh, correct me if my numbers are wrong, India's GDP from 2008 to 2017 has been 4x. We were 500, we are about 2 trillion. Has your net worth become 4x in real estate, gold, or bank deposit? Because if India has grown, as citizens of India, we should be actually growing at India's growth rate. We are not growing. B, what are the alternates which are available if you don't invest in equities or buy the SIP culture? C, any other asset class you invest in, there is a 3-letter word tax, which will always take part of your return. When I go with my 6-year-old son, and if I take a bite out of his ice cream, he always cries. That is what taxes are. They always take a bite out of your returns. So I want to just seed these thoughts here, and we'll address some of these points, going forward. But Nilesh, before we get you back for, final presentation, give this audience an example of someone who, let's say, started SIP 5 years ago, 10 years ago, in a very normal, average scheme. When it's average scheme, equity diversified scheme, have they really managed to beat all other asset classes handsomely?
See, SIP is all about optimization of return rather than maximization of return. SIP is all about generating returns which is outperforming inflation rather than generating the best return in that asset class. There are people who have made tons of money trading in this ring and, investing as well. But do we possess that skill? I want to bet like Tendulkar, but can I do that? I don't have those skills. I have to admit my limitation. So SIP is admitting your limitations, that you don't have ability to pick up stocks, you don't have ability to hold stocks, you don't have ability to time market. But despite that, I want to generate inflation outperformance, and that is what SIP is. So when I today meet investors 5 years, 10 years, 15 years, 20 years back who had started SIP, have they generated fantastic return comparable to, let's say, Nimish Shah or Rakesh Jhunjhunwala? Answer is absolutely no. But everyone can't be Sachin Tendulkar. They have still generated far better return than their cousins who were trading in stock market.
Before I hand it back to Pooja, in television we use a terminology called KISS. And please don't get me wrong, especially for the younger audience. The acronym for KISS in television language is keep it simple. And I think SIP is nothing else but a very simple way of taking care of your financial future. Right? So with that, let's put our hands together for Nilesh Bhai. And I will give it back to Pooja while she'll introduce the second panel as well. And Nilesh Bhai would be back with a mega presentation, so you certainly don't want to miss that presentation a little later in the day. Thank you, Nilesh Bhai.
A huge round of applause once more, please. It's worth mentioning that such an early time in the day, you've already been an incredibly engaging audience with several thought-provoking questions. And we've also seen several of your social media posts continue to pour in. Please keep them coming. Hashtag SIP Day, of course. Now, switching gears. Today, India is on the cusp of reaping a rich demographic dividend with an overwhelming percentage of women joining the workforce. So at this time, we thought it'd be appropriate to dive right in with an investment 101 of sorts that highlights the do's and the don'ts when it comes to SIPs. This conversation is intended for the women in the audience, and I see so many of you, but I imagine that we'll all derive value from the conversation. So to join us in this discussion, may I please invite on stage the Chief Investment Officer of Debt and Head of Products for Kotak Mahindra Asset Management Company, Lakshmi Iyer. Please join us, ma'am. Independent Financial Advisor, Rupa Venkat Krishnan. Round of applause, please. And Independent Financial Advisor, Sujata Kabraji. and to help moderate the discussion, may I please invite back on stage ET Now's Executive Editor, Nikunj Dalmia. Now, Nikunj.
Just say the same thing. Chivalry is not dead. So,
Nikunj, you're a bit outnumbered, but the floor is yours.
you know, Lakshmi and me were having a private chat, and she just reminded me of Janmashtami. So I'm enjoying getting outnumbered with three pretty ladies. So the idea of this discussion is really to understand the psyche of an Indian woman saver. And without me prompting into anything specific, you'll have to hold your mics, I guess. I can share my personal experience. My mother has never saved in a SIP or equity fund. My wife, because I claim to have some understanding of equity market, at least in front of her, she has just barely started a SIP. And before demonetization, either money would lie under the cupboard or it would lie in a bank fixed deposit. So why do you think, Lakshmi, Indian women are reluctant about saving in equity or debt funds?
Firstly, good morning to everyone and happy SIP day. At the stroke of the midnight hour last night, as we were ushering in the SIP day, I put in a tweet, or I, phrased a rap. These days, rap is very trendy. So I, coined a phrase saying that I didn't use words like pappu and stuff like that because audience might feel offended. But I just said that, तुम्हें SIP पे भरोसा है क्या and compounding को वक्त दोगे क्या? And then of course it goes on henceforth. But the point is
no,
that...
we have all the time. You can rap the song. Do we want to hear the rap song? Audience.
Really? I don't think I was prepared for that one, to be very honest. But okay, let me just try to get it because... Okay, the rap goes like this, but you need to be in chorus with me. Is that okay? Only that's the deal. Only then I say that. Is that
yes,
okay?
Yes, of course.
Okay. So let's not say Pappu. Let's say India. तुम्हें SIP पे भरोसा है क्या?
Yes.
No, I can't hear. So you have to say it with me. For those who have heard RJ Malishka, you have to say, when I say है क्या, you please say है क्या. Okay, once again. India, तुम्हें SIP पे भरोसा है क्या?
Yes.
Compounding को वक्त दोगे क्या? मार्केट टाइमिंग की फिक्र छोड़ छोड़, SIP से तुम नाता जोड़ जोड़, SIP के फायदे को देख देख. I am not hearing. I think 15% of the audience has done SIP, so that's the reason they are not energized enough. Or I think Kotak Mutual has not given them adequate breakfast. Okay, SIP से नाता जोड़ जोड़, SIP के फायदे को देख देख. स्टार्ट करो सब अपना SIP एक एक. आज है कोटक MF का SIP डे, हो जाए SIP आरंभ वी प्रे. तो चलो BSE फास्ट फास्ट और मनाओ SIP डे साथ साथ. So this was basically the pulse of India today, and to link it with the question which Nikunj just asked, most of India is, and if I don't want to single out the women population, I'll come to women population in a bit, is unaware that there is something like SIP available, number one. Number two is, again to quote social media, a few days back I said that Indian population is 135 crores and number of SIP accounts we have is barely 1.5 crores. To which somebody says that it's not a right comparison because the number of PAN cards is just 1/10 of what the population is. My point is that if you want the SIP, you will get the PAN. It is not that just because you don't have the PAN, you don't have the SIP. And I'll quote you my maid's example. I have a maid who's been working with me for now 15 years. She started with a measly salary of 600 way back in 2002. And now it's 2017.
You really underpay your maids.
Sorry?
You underpay your maids, that means.
Oh, she is. It depends on where you stay also, right? So now, of course, she's drawing, 7x, 8x of that. But the point is that 8 years back, when this market meltdown, etc., happened, you know, and she had absolutely no means. She's staying in a chamri kind of a thing, supporting. She had 2 kids. Her daughter, incidentally, is doing engineering right now. We are supporting the family. So she came and said that which FD is safe. I didn't understand the question. So I asked, what do you mean by that? She's saying, नहीं थोड़ा पैसा है दीदी, FD में लगाना है, कौन सा बैंक में लगाओ, आपके बैंक में लगाओ क्या? So I told her that it's not about my bank, your bank. I said, how much you want to save? She quoted me the amount, and I told her, you do one thing, you start an SIP. As usual, she didn't have a PAN card. I mean, you know the social work community help us today. We opened we opened a PAN card, we got a PAN card for her, and then we started an SIP. And today she is absolutely thrilled, absolutely happy. In fact, as we speak today, she's taken a small loan amount, but bulk of the house that she's bought under MARDA is actually funded by her SIP. So I think what I'm trying to use to this story is that people, and this is a live example, I have many such examples, but in the interest of time, I quoted the relevant example. What is important today, and it's not just the maid. Okay, my mother doesn't have an SIP. She loves gold. Okay, every Akshay Tritiya, she'll call me, did you buy gold? And I have to obviously use a Yudhishthir terminology saying that yes, I did. Of course, I buy gold ETF. That's a different thing. But the point is that the more you have awareness, you know Akshay Tritiya, you have to buy gold. The entire India knows. You know Diwali, Dhanteras, you have to buy an item. How does that happen? So I think the awareness has to spread, and somewhere it is in the mind of a woman that financial planning is not my cup of tea. Okay, if I'm unmarried, it's my family that does it. And if I'm married, okay, let me delegate it to my husband, and he is the person who will take care of it. So I think it's time we disbandon that myth, and probably, and why I'm calling it a myth, because there is absolutely no reality in it. And once you get aware, now when this maid of mine is aware of it, she has told her fellow coterie, and now I get, you know, queries on a Sunday morning that how do we start doing this? So I think the word of mouth, as Nilesh also mentioned in the morning, the word of mouth will certainly spread. Events like this will have to create or, you know, gather mass momentum. It's only then, and this I think is an evolution. This is not going to be a revolution. But I think it's important to stop giving excuses and start acting, because once the mind decides, the body will find its way to execute things.
Fair point. So, Rupa, 2 follow-up questions. First, when you talk about Indian women and are they serious about financial saving, do you think there is unawareness or there is fear?
So Nikunj, it's not about unawareness or fear. It's basically, as Lakshmi put in, saying that till the time you're married, your father takes care of the investment, once you, or the brother takes care. And then later on in life, it is your husband or somebody in the family takes care of your money. There's basically an insecurity which is there within a lot of women, saying that I won't be able to manage money. But in fact, my perception is saying that the women are the best financial managers because they run homes. And inflation hits the women the first through milk prices and vegetable prices. So they know exactly what's about how to run a home, and they are the best financial planners. But the fear is saying that how do I manage it, and do I have the ability to manage it? Secondly, there is a lot of inhibitions when it comes to money or when it comes to investments. People think saying that you need large sums of money to create large sums of wealth. I don't think so. I think that myth has to go away, saying that you only need small sums of money to create large sums of wealth over a period of time. I think these are true concepts, because when it comes to money, you are so ashamed to share with somebody that I only have 1,000 rupees to save or 500 rupees to save to create wealth. I think that myth has to go away. And that's the myth that I find in a lot of people, saying that I have very little, can I make abundance out of it? So it's fear and the inhibitions to share and talk about it.
Sujata, what has been your experience?
I'm seeing a huge big change in the last maybe 4 or 5 years. So I have a team of women who work with me, and they all come from an economically poorer background. And I think what the big change is, if you educate and take away the fear, then I'm finding it hard to hold them back. They want to put everything in equity rather than have a balance. So, you know, I think fear holds women back, and they feel ashamed to admit that they don't know. But once you teach them, I think, like Rupa said, they make better financial planners.
Do you see, Sujata, that in last 2 or 3 years, the entire saving culture, at least at Indian Women Saver, is changing, and it is changing very, very radically? It could be awareness, it could be ease, or it could be compulsion.
With the younger generation, I see a big change. Recently, over the weekend, I met a group of senior citizens in their 70s, and they were basically talking about, they're all widows, and you know, life expectancy of men is definitely lower in our country. And all of them, I asked them, I said, what is it that you would do differently financially? And all 4 of them said that if we knew more, we wouldn't be in the situation that we are today. So I think even at that generation, they are aware there are options. And I think media has played a bit of a role in making them aware that you don't need to only save and put it into gold. I mean, that's what all 4 of them did all their lives. They used to have household money, they used to put it away, whatever they saved, and then they went and bought gold, Akshay Triti or wherever, and that's the only thing they have. And they have a psychological barrier selling gold. Whereas if they saved in equity, there's no emotional attachment.
Of course, you know, you want to see, you can see gold, you can see cash under your cupboard, and that just gives you this sense of security. That's human nature, I guess. Actually, a very basic follow-up question. Since we are targeting Indian Women Saver here, Indian Women Saver are ultra-conservative. They have token amount which they save from their household expenditure, and that is their entire saving or their corpus. Should an average Indian woman saver not invest in equity SIPs at all?
Should she or should
they invest? Because equities ultimately will give you a bout of volatility. It could happen for 2-3 years, it could happen for 3 years, but if you are investing in equities, you have to digest pain and volatility.
Absolutely. So I think the answer to that is a definite yes. And it's been going, it's a parampara basically, at least in the Indian fraternity, that when a woman is wedded, she gets some sridhan into the household, and that sridhan is typically gold, cash, anything tangible. I think this is the era where this same woman has to inherit sridhan, and that sridhan has to be SIP. And why SIP? The question one can always debate is, I can trade in the equity markets, I can make the quick bucks. In fact, I have an aunt in Pune who calls me up and tells me that 500 rupees ka koi stock boliye na. I said, what is the meaning of 500 bucks? What is the myth with this 500 bucks? And she says that I have 5,000 bucks to invest, so I can buy more quantity if you give me a stock tip of 500 bucks. And the apathy here is, and for those who understand, I'm sure all of you understand, is that it doesn't matter. The face value or the NAV of the stock or the scheme does not matter. So I think basically SIP is definitely the way to go for a woman specifically to get initiated into the world of finance. And trust me, so Chinese, why do Chinese have green tea? And it's an open secret that Chinese women can delay aging to a very large extent, because typically green tea has got those antioxidants which can prevent or delay aging. You can't prevent aging, of course, for the longest period of time. And I think SIP is that green tea to your portfolio predominantly because it will do wonders to you much beyond your life and much more beautifully or miraculously than you could have ever imagined. Whereas gold, it's not that I'm against gold, but gold will just lie over there. It's a dead asset. It does not add to the productivity of the country. So it's time women change the mantra that my Sridhan is my SIP.
So now we know why you look young. Is it green tea or sip?
It's both basically.
Okay, I have a question for the audience here. And the question is very simple. How many of you have made a merchandise purchase of 2,000 or 2,500 rupees in last 3 weeks? Just raise your hand. We don't have too many shoppers here, man. Come on, be honest. We're not recording it. Even if you bought it online, you can tell me. Okay. Now, Rupa, imagine some unnecessary or forced purchase which we do either on internet or we go to movie hall and instead of popcorn we also buy that soda. Now this is just for the young audience here. If they just avoid the temptation of buying a shoe, one t-shirt or one weekend movie, how much can that save or make their life if they start a SIP?
Oh,
There's some magical numbers here, right? I'm
Yes.
sure.
I don't know if I can share those magical numbers, but the question is, I do mesmerize a lot of youngsters saying that how many times they go to a pub or a hotel and...
You mesmerized me when I met you, but I'm not young.
So I used to ask them saying that how many times... So normally when I meet a young guy and when I talk about SIP, the first reaction is, I don't have money to save. So I just ask a question saying that how many times do you go to a pub or a hotel or a restaurant? And it would be 5 times and 6 times. And every time that you spend, it's 1,000 rupees or 500 rupees. So I asked him 3 months back, where did you eat? And with whom did you eat? And what did you eat? I don't remember. Not even 2 weeks back you would remember what you ate or what you did. So I said, fine, if that is the case, if you can give me that SIP, if you go, instead of 4 times, you go 2 times to a restaurant, and the 2 times that you don't go, give me as a SIP. After a few years, I think you will have money to go and pub in a 5-star hotel. That's the kind of wealth that you can create over a period of time and save, and it's all about discipline. I think it changes. It just gives a little time, but it just changed your mind, because investment is all about psychology. It's all about experience. It's all about how do you put yourself. When you ask Lakshmi about investments, risk, I think the day a woman comes in, gets married and everything, the first thing that comes out is financial security for herself and for the family. And I think that savings bit starts immediately in your mind. And the first thing that we have learned over a period of time is saying that you do a bank fixed deposit or you do a recurring deposit to save yourself. I just wanted to share my mother. My mother started an SIP in gold in 1968. Okay, this was with a store called as Tangamaligai, which is in Chennai. And I learned from her, because when I was 7, 8 years old, I used to go, every year she'll go to Chennai and invariably go there and renew 100 rupees every month, and she used to do a money order. And I used to wonder what she was doing. Later on I realized saying that she used to do a SIP to buy gold. And so it is not that women have not done SIPs, but technically if you look at South, basically people used to do it in gold. But so the concept of security is all there in women, and my experience has been, if a woman understands that she has to need save and financial security over a period of time for her children, for herself and for the family, I think it's not about returns that matters, it's about how do you create that. That's more important. So it's knowledge. It's about sharing and experiencing, giving them that experience, saying that how do you save and how do you create wealth. That's more important. So I think all the youngsters here, you can stop going 4 times a week to the restaurant, go 2 times, and you can pub after 15, 20 years in a 5-star hotel.
Or if you want to look young, have green tea.
Sorry?
Like Lakshmi said, I mean, if you want to look young and stay happy, then the other option is green tea.
Absolutely. And by the way, I do pub every week, so it has not stopped me from pubbing as well.
So she's pubbing because she's been saving in SIP for the last 25 years.
Absolutely.
Okay, so I'll keep it open. I mean, we'll encourage some, questions from the floor. And yes, please.
So while you just mentioned about going online and buying clothes, the only thing that I've got as a financial advisor, I've been going to people and asking the same thing that you told, that you go and how much have you shopped since last 1 month or 2 months, and you can just give me a SIP instead of that. The only answer they gave me is, when I buy a shoe, I get a product. But in doing an SIP, they think that my money is getting locked somewhere. So it's like they have that guardian in their mind that I'm not getting a product for what I'm paying for. So this is something that is hitting youngsters nowadays. Being social, like looking good, is something which is very important for today's youngsters, being online everywhere on all social media sites. But the awareness how online clothing is coming into action, the investment portfolio, investing is not something which is as aware as how online shopping is. So anything on that? I mean, how do we divert people's mind from, I mean, not buying online, but getting a discipline on what they are buying online and shifting their expenses to investment?
Shraddha, everybody's looking for instant gratification. How do you stop that?
Actually, I face that question a lot. So the way I look at it personally is, I ask them, have you been out to eat or ordered a Domino's pizza? Most of them have. And then I say, okay, after you've eaten it, you feel a little full and you feel a little happy, but I'll ask you 2 hours later and what do you feel? It's gone, right? You can't get it back. But you do put on weight, you have all these other issues which you're not thinking about. So, okay, you want a Domino's pizza, have one, and the same amount you put away as an SIP. And I think it's been quite successful because people are aware that, they can't get their food back, and this SIP is similar. Instead you get it back, but you get it back a few years later. You could try that.
Let me assure all of you, the lunch is on the house. So don't try and save the lunch. Okay, any more questions? Yeah. I'll make sure the mic reaches you after this.
See, one reason which is inhibiting the spread of mutual funds and SIP is the very stringent KYC norms which are there in place. Everybody doesn't have a PAN number without which he can't open a mutual fund account. Now my question is, with 97% of population now having Aadhaar number, whether this KYC can be replaced instead of having a PAN number, just giving an Aadhaar number will suffice the KYC requirement. If that is achieved, I think the spread of mutual funds will certainly increase. So probably this needs to be taken up with regulators. So what the panel
Does it
thinks about
stop someone from starting a mutual fund because they don't have a KYC? I mean, is it a challenge?
I don't think so personally. Of course, the Aadhaar is a great suggestion, and of course, I'm sure the regulators are mulling over the same. But let me take an analogy to explain this. You're an avid trekker, okay? You love walking, and you love heights, and you're mountaineering basically. What derives or what gives you more kick? Going to probably Pune and doing a Bhima Shankar trek, or probably trying to scale the Mount Everest? And I'm sure for an avid mountaineer, the latter is the truth. So the point is that yes, there is perception that KYC is very cumbersome, but today we have 5,000 crores per month which gets into the industry. We have 1,65,000 crores worth of SIPs in the industry, and we have 1.45 crore SIP holders who have undergone this ordeal because they know that scaling Mount Everest is more important or more kickful for me than trying to do a local trek. So my only submission is that, a bad carpenter will tend to find fault with his tools. My only submission to this entire audience is that, and I'm a movie freak, okay? I don't miss a single movie. For example, right from Mom to Toilet Ek Prem Katha to the most, I would say, half-star rated by critic movie, I would go and watch it. My only submission to each one of you is, and I'm sure there are few movie fanatics in this room as well, and food tasters also in this room. So if we go and check out movies for ourselves and we invest that money, assuming we invested, but it was a dead cost, and every movie on an average at least costs 200 to 300 bucks, unless you see a morning 9 o'clock show, which is very difficult to catch at 100 bucks. My point is it's 500 rupees SIP per month. I don't think it's a big deal. So the difficulty is predominantly in the mind, and as I said, if the mind is conquered, the body will find the means to achieve it. Having said that, I do understand that things have to be made cumbersome. If you are scaling Mount Everest, you need to have the right kind of equipment. I can't give you local shoes and say that chado aap pahad. That's very difficult to achieve. So yes, that is a fair point taken into cognizance, but that should not be an impediment. See, if you need to lose weight, you have to get onto a diet. But that does not mean I can't eat gulab jamun, because even in dieting there is a cheat day available. So please use that and please start your SIP.
Excuse me, but I raised that question in the context of people who do not have PAN numbers wanting to invest in mutual fund. I have a maid servant who would like to invest in mutual fund through SIP. Now I ask her to obtain a PAN number. She says, what am I going to use that PAN number for other than SIP? When I take an Aadhaar number, I can use it for so many purposes. So I'm not going to apply for a PAN number just for the heck of investing in SIP. So if PAN number is replaced by Aadhaar number, I'm sure we'll have a lot more mutual fund folios than probably we have now.
So
That's the
I
point
think
I'm
there's a move towards that already. So hopefully your wish will come true.
Sir, my son eats almonds, but my maid's son eats peanuts. Both are high in proteins. My only point is, sir, right now, ask your maid to speak with my maid. Let her be convinced. Because if you and me try to convince, they may not be convinced. So till such time that Aadhaar is made available, you have to make do with the next best option right now.
You can invest a small amount through the Aadhaar already.
Yeah, my point is, she doesn't want to apply for PAN. So how does she invest in mutual funds?
No, without the
That's the
PAN,
point I'm trying to make.
no, without the PAN, you can use the Aadhaar and invest already
Small amounts.
for smaller amounts, and it's moving towards the Aadhaar pretty fast, so you'll get there.
Can I?
Yes, please.
Yeah, I'm a teacher, basically drawing salary from the government. For us, we get two type of people, those who come to us for investment purpose. So some of them, they are related to insurance, and some of them, they are related to mutual fund. When the question comes for insurance, people, they find it more lucrative, and they get more attached to the insurance dialogues and all. And when it comes to mutual fund, that psychological fear, what Madam has said just now, it comes automatically because it starts with the slogan only, it is subject to the market risk. Because that word risk, when it comes, psychological fear starts. And when you see that, okay, the losses are not protected and it is not insured, as Sir has said rightly, when things are not insured, when it is not protected, so that fear, it is going to be more on the people's mind. So, is there any suggestion for this? And apart from this, there are charges involved in that, that is 1 to 1.5%, that is called administrative expenses. That is our money, which is governed by the government or supported by the government, but why the charges are there?
Rupa? Insurance versus investment, good old debate.
So, sir, I'll put it this way. When you said saying that, you know, when you read that caveat which says subject to market risk, I think you have cigarette smokers right here. There is a risk perception given, which is given on cigarettes, but still people smoke, correct? If you think saying that there is a risk caveat which is written, I think our perception is saying that we need to go and ask, find out what exactly is the issue. It's something like if you have to travel from Mumbai to Trivandrum, as all of us, what we will do is on the internet find out how much is this going to travel by a first class, how much is this going to be traveled by a train, how much if you take a flight, and which one, SpiceJet, Indigo, correct? We go and find exactly how do you want to commute as per our financial ability. In the same way, when you have to invest and create wealth, see, all of us as human beings, we are aspirational. We all want to create wealth. We all want to live better, eat better, lead a better life. If that is the way, then we need to find out saying that what are the other investment opportunities which are available, which will add value to our life, which will also add financial stability to the life over a period of time. Because in India, you need to save yourself. We don't have social security. So the first thought has to come is saying that we need to see and create wealth over a period of time when we retire. All of us need to know. How do you create that? Because at the end of it, money is purchasing power. Your money that you earn has to have that ability to grow, to sustain your livelihood for the rest of your life. If that is important, your questions will be answered when you talk to 10 different people, when you go on the internet and read, share your experience and understand what it is, and then take your decision. I think it's very important that all of you, rather than sitting on the sideline and saying that I am not aware of it, let's start working towards it and say that how better we can do our life. On the expense part of it, so it's a 1.5% expense or 2% expense, which is which SEBI has put there is a cost to it, sir. There are so many people working at the back end to give you that kind of alpha and the returns. There is a cost to it. There is nothing free lunch in this world. Even for an education you have to pay, and I think it's a minimum cost. Look at the kind of returns that you get vis-a-vis the expense that you pay. We look at the expense and as Nikun says, most of the investment that we do is because to save tax. The first investments that we do is to save tax. We never invest to create wealth for ourselves and being financial beings. I think the myths and the thoughts have to change. All of us need to change. Only when you earn, you pay tax. If you don't earn, you don't pay tax. So let's start thinking about creating wealth and making money and then think about tax.
Thank you so much. Thank you.
Any more questions?
Yeah.
Right from the back here.
Yeah, I have a short question about this expense ratio. Do you have direct plans also in SIPs? So you have regular plan and direct plan under mutual fund. So in SIPs also, do you have a direct plan?
Yes, they do have.
Just like
yes.
Okay, good.
Okay. Yes, sir.
I have a very challenging question. It's more challenging, the young people these days are not like the old guard who were saving, because we had a vision and mission to save for the future. The young have a lot of cash. We are living in a consumer world. So how do you get these young folks to save? Do we catch them young at this stage, or do we start in school where we educate them? Because all the kids worry is about burgers and iPhone 7 Plus and blah, blah, blah. So the first thing they get out of their wallet is to drop in buy a phone or something. So how can we get these folks to save? Because their dads are spending the money. You know that phrase, iPhone, I spend, I saved. Thank you.
So the mythical answer or the mythology answer to that is Abhimanyu learnt about Chakravyuh in his mom's womb. So it's very important to understand that the essence of financial savings, irrespective of the gender, has to start at an early age. And children emulate people or surroundings around them. Children emulate their parents. Children emulate what they see around them. And that is the age when the essence. Warren Buffett says, I started at the age of 9, at the age of 12, and he said I started late. So the point I'm trying to say is that it's very critical for us to get initiated. Today my son has, he's all of 11, he has already a junior bank account. He's understood, we of course try to inculcate how do you do, so we have this pocket money system, so with kids, I'm not talking about millennials, one down the millennials, just about to be teens, you have this pocket money system. Pocket money is not given one shot for the entire year. Pocket money is given on a tranche basis. It's given maybe once every 15 days, once every month, typically once every month. So the inculcation starts from there, that if you start with this amount, this is the kitty that you have, how much you want to spend, how much you want to keep, and how much you want to start saving. So I think while there is no rule of the thumb or a time-tested proven formula for this, in US, there is this trend that millennials are owning 30% of the investments. So there is this trend that millennials are heading towards investments. Why are they doing that? The reason for that is because everyone incrementally will start believing that if you have one villain, in movie there could be various villains, but if there is one villain in the real world and that villain is inflation, one will realize that no amount of traditional mode of savings will allow me to beat or defeat that villain. So there is only one hero, and that's financial savings, aka equities. And that, if you want to achieve, you have to achieve it in a disciplined manner. So I think watch them, spot them young, watch them grow. So keep targeting. See, if you take a hammer and you hit on a metal, even that forms into a sheet. And we're talking about human beings with soft and supple brains. So it's just about harnessing the right thing in the right direction and trying to hit the same thing again. This morning somebody tells me that SIP is very old-fashioned. Tell me something new. My point is, Bruce Lee mentioned that he is worried about the man who does one kick 10,000 times. So I think if Bruce Lee were to be worried about that man, we better be worried about our investments.
Can I just add to that? It's a really interesting and tough one to think about. What worked for me was this 22-year-old who wanted to buy the latest iPhone, and then I asked him, what else do you want to buy? And he said, I want to buy a Merc. So I said, fine, what's more important? And he said the Merc. So now he's got an SIP running. So I've kind of deferred the, purchase. And I feel by the time he reaches the amount that he needs for a Merc, it's going to be a long time. And hopefully his priorities would have changed by then. So sometimes you got to fool them.
Yes, please. Please go ahead.
See, nowadays the gentleman has asked question how to induce these young people to save, but they are wise people. They spend as well as save also. First they go in for their house, flat or something, and simultaneously whatever amount they out of EMI or paying EMI etc., they go in for investment also. I have seen at least I have come across number of people, my relatives who are well placed in IT industries etc., their colleagues etc. So the present day generation are having this habit of saving. We need not tell them, they know what is their future. They save it.
Thank you, sir. You know, I want to make this. Yeah, please. Sorry, I just. So, ma'am, I'm hoping you have a SIP, right?
Yeah.
Wonderful. Let's clap for that.
My question is, okay, SIP is for people who have regular income, like salaried people. So what about people who have erratic income? Sometimes they make money in a month, sometimes they don't. They get a deal, they crack it, and they get good amount of money, and sometimes they don't get, and they don't make money. Then how can they make SIP in that case?
That's a great point. And I want all three of you to respond to this point.
There's an alternative to an SIP which is called an STP. So whenever you get a lump sum, you park it in a liquid or a debt fund and set up a regular transfer into equity and keep doing that every time you get a lump sum. So that's one alternative.
But then that defeats the whole purpose of systematic investment plan. I mean, you may have lump sum amount to invest when markets are high. You may get lump sum amount when markets are low. So then the law of averaging, the entire maths on which SIP is based, that gets destroyed. She has a very valid point.
See, a lot of people who run their own businesses, they function like this. They get lump sums. So basically, that's what the STP is for, right? Whenever you get the lump sum, you power your liquid, and then you set up your STP equivalent to sorted. It doesn't really.
The other way to look at it is assuming it's SIP and lump sums may not be available for STPing. Look at it this way. And again, I'll take very basic examples. What are we habituated to? Irrespective of whether the world collapses or demonetization happens or layman comes to an end, we do have our daily routine, our morning brushing, bathing, eating. We might skip probably a meal or so because of depression if we are too much into trading, etc. How do we find means or resources to achieve that? Because it's a habit, right? So you may have a shower, but shower without a soap if you don't have money. Or you may buy a high-end soap, a foreign brand, and you may probably not use a local one, or vice versa. My only submission to you is, if you make SIP a habit, you will find means to achieve that end. When demonetization happened, I had my security guy saying that biscuit खाने के लिए भी पैसे नहीं है. मैंने बोला चाय तो पीते हो ना? So the point is, अगर चाय की पत्ती के लिए पैसे आते हैं, तो कहीं से जुगाड़ हो जाता है. So I think this Indian system is expert in जुगाड़. It is very important to harness the जुगाड़ in right direction. अगर गर्लफ्रेंड को पिक्चर ले जाना है कहीं से तो आपको पैसा मिल जाता है. वैलेंटाइंस डे के दिन अगर आपको डेट करना है तो यू फाइंड अ मीन्स टू टेक हर और हिम टू अ 5-star प्लेस. How do you do that जुगाड़? SIP is not a priority for that person who believes, and again, this is, it's not philosophical because I have encountered various such people, millennials, students, senior citizens. I have 2 examples in my own house. So I don't need to look beyond. Charity begins at home. So my simple point is, let's stop giving excuses. Let's find out a jugaad. Start at the bare minimal amount and then do SIP top-up. Today, industry is generous enough to allow SIP top-up. So once you get clarity on what your stream of income is likely to be, it's going to be less lumpy, less chunky, more stable, do a SIP top-up. But don't stop doing it for the sake of saying that, yaar, ye to nahi hai hamare paas, ye nahi ho payega. Once you decide, as I said, I will repeat, when the mind decides, the body will find means to achieve that end.
I'll answer your question saying that I'm sure saying that whatever the amount of money that you're earning, you're not going to save the entire money in SIPs, right? You're going to only take 10% or 20% of that money that you earn to put it in an SIP. So if that is the way you planned your SIP, I think from the income that you accumulate, you're not going to spend everything. So I'm sure there is a bank balance which has a cash flow, which you have to match your cash flow with that kind of income and save only that much, which gives you that comfort to save consistently. I think it is all about planning.
It's all about planning. And yes, please. Okay, why don't you ask a question while the mic reaches the gentleman?
नमस्कार सर, आपका धन्यवाद सबका कि आपने यहाँ पे कोटक म्यूचुअल फंड की तरफ से सिप डे चालू किया है।
आपके पास सिप है नहीं है?
हाँ सर, मेरे पास जो सिप है, मेरे पास HDFC टॉप 200 का सिप है और HDFC बैलेंस फंड का है। 6-7 साल से मैं SIP कर रहा हूँ सर।
Wonderful. Let's put our hands together for anybody who has a SIP, because only 15% of the audience in the morning they had a SIP.
Absolutely.
जहाँ पे मैं काम करता हूँ म्यूजियम में, छत्रपति शिवाजी महाराज वस्तु संग्रहालय, वहाँ पे मुश्किल से 400 लोग काम करते हैं, तो मुश्किल से 5 या 6 लोगों के पास ही SIP है। और मेरे को HDFC म्यूचुअल फंड से डेली मैसेज आता है कि ये के बारे में, तो मैं सबको दिखाता हूँ इतना इतना मनी ग्रो होता है, कभी डाउन होता है, कभी अप होता है। तो मेरा उषा मैडम से सवाल है, आयर मैडम से, कि 60 साल के बाद अगर अपने को फिक्स मंथली इनकम आना चाहिएगा, तो किस बारे में, कौन से फंड में जाना, फंड का कोई नाम भी बताइए कि मंथली उसका जो अपने को जो गवर्नमेंट को जो हर महीने 5 तारीख को जो अपना पेंशन जमा होता है ना, ऐसा कोई फंड है जो अपने हर महीने जमा हो जाएगा, जो भले अमाउंट ऊपर नीचे हो जाए मार्केट तरफ से। बस इतना ही मेरा सवाल है, प्लीज़ हिंदी में बोल दीजिए प्लीज़।
नहीं, आपका सवाल है आपको मंथली इनकम चाहिए, वो बता रहे हो आप?
हाँ, 60 साल के बाद अगर पेंशन जैसा मिलता है गवर्नमेंट सर उनको, वैसा म्यूचुअल फंड की तरफ से मंथली कुछ इनकम मिलेगा हर महीने?
देखिए म्यूचुअल
फंड, I think first we should clap a hand for the gentleman, considering how disciplined he is.
He is an inspiration, absolutely.
His aims are clear, his goals are clear, and his need also is very well defined.
Absolutely, सर आप लंच में एक एक्स्ट्रा मीठा खाना आपको हक बनता है, डेफिनेटली। सर एक चीज आपको बताती हूँ, म्यूचुअल फंड में ना एक चीज की अश्योरेंस नहीं होती, गारंटी नहीं होती, वो है रिटर्न्स की। और आपको कोई भी अगर बता रहा है तो मेरे हिसाब से वो सिर्फ सिरकी ले रहा है मेरे हिसाब से। तो आपको कभी कोई म्यूचुअल फंड से गारंटी रिटर्न नहीं मिल सकता, गारंटी इनकम नहीं मिल सकता। पर एक माध्यम है, जैसे इंडस्ट्री में, हमारी जो म्यूचुअल फंड इंडस्ट्री में एक कैटेगरी है जिसको हम बोलते हैं मंथली इनकम प्लान। अब वो मंथली इनकम प्लान फंक्शन कैसे होता है, अगर आप एक अमाउंट आप जमा करते हो म्यूचुअल फंड कोई भी स्कीम में, जैसे आपकी इच्छा हो, वो महीना दर महीना या फिर 3 महीने में एक बार या फिर 6 महीने में एक बार, मतलब आप अपना फ्रीक्वेंसी आप डिसाइड कर सकते हो कि आपको महीना दर महीना वो इनफ्लो चाहिए या फिर 3 महीने बाद चाहिए या 6 महीने बाद चाहिए। उस स्कीम या उस कैटेगरी में आप निवेश कर सकते हो। फर्क इतना है, जैसे मैंने आपको बताया, इसमें आपको गारंटीड इनकम नहीं हो सकता, लेकिन कुछ म्यूचुअल फंड्स के पास ये ऑप्शन है कि आप टिक कर सकते हो। जैसे आप फॉर्म भरोगे तो आपके एडवाइजर आपको गाइड कर लेंगे, या फिर आपके जिनके थ्रू आपने निवेश किया वो आपको गाइड करेंगे कि वो आप टिक कर सकते हो कि आपको कितना अमाउंट चाहिए से 1 साल बाद या 6 महीने बाद, या फिर कितना परसेंटेज रेट ऑफ इंटरेस्ट आपको कितना चाहिए, आप वो टिक कर सकते हो। उस हिसाब से वो आपको गाइड कर सकते हैं, लेकिन वो आपको डिसाइड करना पड़ेगा। म्यूचुअल फंड आपके हिसाब से आपके लिए डिसाइड नहीं करेगी वो।
ओके, थैंक यू मैडम।
Okay, yeah.
I got several SIPs, about around 10 SIPs I got.
10 SIPs?
Yeah.
Wonderful. We'll clap very loudly for you.
Like in Birla Sun Life, HDFC and Kotak and several others.
Now Lakshmi will clap because he's saying Kotak.
Yeah. The thing is, I had invested in large cap funds and mid cap and small cap. So earlier there was mid cap and small cap was performing very well, but nowadays I seen that the large caps are performing well. So my question is whether I should exit the funds which are not performing well now, or how it should be like. I should continue with that.
Your small cap fund is a Kotak fund or a...
No, different.
Okay.
So obviously, if you tell me that your Kotak funds are not doing well, I will say lage raho, you should not exit. That would be obviously a biased view. But jokes apart, see, I think when you are into long-term investments, let me take an example of a child, okay, just to make it simpler to understand. If the child is always scoring a 10 on 10 in a particular exam and continuously the track record has been 10 on 10 and suddenly the child starts scoring 5 marks, 6 marks, 4 marks, what do you start saying? Is the child a duffer? You start understanding or you want to analyze why the child is not doing and try to guide. Intrinsically, the child seems to be talented. It is not a tukka where you're consistently scoring a 10 and then after that you start scoring poor marks. So I think fund management or fund manager's job is also something similar wherein there could be some good days, there could be some bad days. I have yet to find in my own, and since I'm a money manager, I can say that with confidence, I have yet to find, somebody who has been consistent in all cycles over maybe 15, 20 years time. And the kind of SIP investments that we are talking about is over the next 15, 20, 25 years. So I think form is very temporary, class is permanent. So if there is nothing significantly wrong, which obviously your advisor will be able to guide you well, if there is nothing significantly wrong with the fund process, philosophy, etc., even though there is a near-term pain, I think you have to stick and look forward to that long-term gain because 19-20 ka to farak rahega, and that is the reason you have been advised to diversify.
No, the thing is that my advisor is not advising me well.
I'm sorry?
My advisor, financial advisor, is not advising me well.
So then you need to go with your advisor, right? That's what I'm saying. So whatever your you have an advisor, but your advisor is not advising you to move out.
Properly, yeah.
So you have to listen to your advisor.
Is not proper. His advice is not proper. Then
Okay,
what
there's
should I do?
another way.
Okay.
Basically, there's a lot of research available on the internet. If you just check out your scheme and how it's performing against the category. So if you're a small cap and all small caps are underperforming at the moment, then maybe you can wait it out. If your particular fund is underperforming for an extended period of time versus the category, then you need to look further.
No,
I mean, she's perfectly right. You have to dig deep as to why is the fund not performing.
Rupa, let's hear from an advisor here.
So you also need to look at the time period that you're comparing with. Okay, don't look at a very shorter term period of comparing in an SIP. If you don't have 5-10 year view of comparison, if you're going to look at 3 years or 2 years comparison, SIP returns are not going to give you the right kind of returns. You need to look at a 5-10 year period and see that what is the past, how it has performed, what is the present. So more importantly, what is it you're comparing? Is it the time period? Because everything is cyclical. You have a mid cap, large cap, everything. So it's all about cyclical, how you have done your asset allocation even on your SIP. And you have to see averagely how much you are earning rather than just comparing one to one.
Okay. Now, we've shamelessly actually extended our time, and I'm promising you that we have no intentions of eating into the lunch time. And so before we start the next panel, I'll misuse the liberty of my anchor chair for just one final round of questions. And this question is for all three of you, and I'll start with you, Sujata. For someone who's planning to start young, and since we are trying to address the need of women empowerment here, how Indian women they are not investing, how should a first-timer start for someone who has a 15-year time frame? And let's say the token size here could be 1,000 to 5,000 rupees. Because that's the audience I think we need to address.
I think what's worked with me over the years, and it's been a great learning, is when a girl is starting initially, just stick to very safe, very non-volatile products till you build confidence.
Even if you're young, start with low volatile, because that's the time you should ideally be taking the highest risk.
Because otherwise, with fear, they go away.
Okay. So start with a balanced scheme.
Do a proper risk profiling. I think that helps me a lot. And then start with non-volatile and let them build the confidence and keep educating them on the advantages of the product they've chosen, and then bring some volatility in.
Lakshmi, I'll change the profile here for someone who's in 30s and she wants to start afresh. She's attended today's camp and is feeling confident that, look, I want to park maybe not 50,000 but 5 to 15,000 every month because I'm feeling confident now. what should be the allocation? I mean, the general advice is look at your risk profile. But if you can just granularize it a bit.
No, so the answer to that is that at the age of 30, I am more excited to do a bungee jumping than probably at the age of 50 or 55. So I think go for the plunge. It makes a lot of sense. The caveat here is that you may not have or you should not be having an immediate capex in mind over the next maybe 3 to 5 years. But I would certainly advise her to go for the kill, go for an overweight equity portfolio. Of course, keep some small contingency, and within that equity allocation, you decide how you want to pan it out. If you're more disciplined, then obviously the SIP, and if you're the slightly, the spendthrift sort, then you put in a lump sum and then just ride through it. But definitely, even at that age, I would recommend going for the overkill, not just the kill.
Rupa, the next age profile could be 50 plus. She does not have volatility to digest market ups and downs, and is looking at occasional income to buy her grandson a gift or maybe give her daughter something on her birthday.
So you have a lot of debt products which are available, which is like, it could be an MIP or if. So most of the time I can only tell you, Nikun, saying that not that everybody uses their entire money that they have. It's all a wealth generation that they create for multi-generational generations that you create wealth. Secondly, the concept of risk is so badly undermined, saying that people say that equity is risky. I feel not investing in equity is a bigger risk than investing in equities. I think most of us forget about it. And if you look at our asset classes or asset basket, we don't even have investments which have given better returns than a fixed deposit. Or the problem is because we have never experienced. The only experience that most of us have is experience in investing in a real estate, in a gold, or in an asset class like fixed deposit. We have never experienced and wealth which is created through SIPs or through any other asset class like a balance fund or an equity fund or a MIP or a debt fund. So I think it's giving that experience of that investor, saying that what are its pluses and minuses, and see that what fits into her and her risk-taking ability.
Fair point. So I guess we've really covered a range of topics on how exactly Indian women should be investing. India, like I always say, is a land of savers. It's high time that we become land of investors. Like Rupa pointed out, that the Indian housewife is the smartest money manager. She really knows how to manage the price of onion and tomatoes and also add to the saving. It's just that the fear, the compulsion, the awareness has to kick in now. So some food for thought here really could be that if I look at India's current GDP, it has gone up 4 times in last 4 years. India's savings currently is at 25%. The money which has come post demonetization is a humongous number. Still that money is still lying in savings account. Only and only if that money is channelized back into other investments, the return could be very compounding. So let's put our hands together for the lovely ladies. It's been a very engaging and a very, learning experience for me. And I really enjoyed my presence here.
And Nikun, since we were specifically intending this for women audience, I just want you to leave this room with one name, that is Tina. That is, financial savings is Tina. There is no alternative. So the sooner you wake up to it, I think the better it is for you.
And thank you for all the health tips also. They're quite lovely. And with that, I'll give it back to Pooja. And Pooja, have you started a SIP? Yeah. So let's clap for Pooja as well, because she also started a SIP.
We can do better than that. Another huge round of applause for our woman panel, please. Right. And some of the nuggets of wisdom that they've imparted have already begun trending on social media, again by the hashtag SIP Day. So to build on this momentum, now we thought it made sense to explore firsthand how SIPs as an investment vehicle inculcate financial discipline and why they are considered to be enablers in the context of long-term wealth creation. To help shed more light on the topic, may I please invite on stage the following guests. Chief Investment Officer Equity at Kotak Mutual Fund, Harsha Upadhyay. Founder and CEO of YS Capital, Yogesh Sharma. CEO of Verity Fin Solutions, Dinesh Khemlani. And Chairman of the Foundation of Independent Financial Advisors, Dhruv Mehta. And to help guide the conversation and touch on the possible perils of not investing, I'd like to invite on stage Senior News Editor Markets for ET Now, Tanveer Gill. Tanveer, take it away.
Thanks, Pooja. Good afternoon to everybody present here. We really value you taking our time from your busy schedules to come here and be a part of this investor education initiative. We're calling it the SIP Day. And, Nikunj and I were having this conversation earlier on, maybe he touched upon it as well, that by default, SIP as an acronym has picked up quite a bit. So on Google, if you did SIP, or you just typed SIP, the first thing that would pop up is systematic investment plan. So it's a concept that's gaining momentum. It's an investment ideology that's picking up, and we are only glad to know that there is a more prudent style of investment that investors, retail investors especially, are honing their skills on and taking forward. Today was a very busy day in the markets. I was thinking of, starting off the discussion talking about the whole concept of save, invest, and grow, which is the Mool mantra that we are advocating here as a way to get into the markets, invest in the markets over the long term through the SIP route. But it was a busy day for the markets because the markets fell. There was all that talk about Infosys. Mr. Vishal Sikka quit, and that had its impact on the stock price of Infosys. What's really important, and Dhruv, I want you to start off with your opinion on this, is at a time when we do these discussions, the markets are really at highs, and we are still in a very good zone when it comes to the markets. But for most investors and most first-timers in the market, a day like this is when they raise the question of, should we invest in the markets today or not? Is this a good time? Because every time there's a correction, rather than investors getting confident about stepping in and buying dips, there's always a skepticism that will the markets go down further. So, in talking to your clients and talking to people that you deal with, how do you advocate them to approach the markets through its volatility?
So, I think the way to approach is that, at least what I have experienced is that whenever the markets are volatile, I've never received a phone call from a SIP customer. Because over time, the person who is doing a regular savings, he has been, you have interacted, educated him that it is good that, the markets go down because your money will be going at a lower NAV. And even when the money is going at a higher NAV, he is not that much concerned, although he's getting a little higher price, because you have explained that it averages out. So what happens is that the customer, when he's putting regular money, actually it takes away the whole attention from the market timing and the market volatility. And it is the larger customer or person who wants to invest a large lump sum amount. And large by meaning I'm saying relative to his net worth. So even a person who wants to put 1 lakh rupees and that is his whole net worth, it's a large exposure that he wants to take. He is very concerned about the market volatility, that if I invest today, will it fall down? So that's where I think what we try and do is that try and address, okay, is this the money that you need over the next 5 years for any purpose? Do you need it for your living expense? Do you need for your short-term goals? You want to buy a car? You want to buy a two-wheeler? So what is the money that you need over the next 5 years? If there is any expenditure that you have planned or unplanned, that is the money which should not come in the equity markets. And I think if you explain that and the customer comes with that mindset that he is investing even a lump sum and the time horizon is, say 10 years, 15 years. And I think it's very simple if you point out to people that, like a lot of the young, now when I meet young clients and I ask them, what is your date of birth? Say if somebody is born in 1990 And then you ask him, do you know what was the Sensex in 1990? You know, most youngsters don't remember. And you tell them...
Our very young clients.
So in 1990, in 1995, the Sensex was 3,000, 4,000. Today the Sensex is 30,000. And during that period, a lot of volatility has happened. You know, the prime ministers have got assassinated. You have had, you know, the war. You've had US. So a lot of things have happened. And therefore, over the long period, if you just give the simple message that over a 5-10 year period, the values are going to go up. And that is, you know, what can help in overcoming the volatility. The time period, are you investing for a long term, or you're investing regularly when the markets go up or down, it doesn't matter.
Right, like I said, you know, the theme of this discussion essentially is save, invest and grow. Dinesh, while we've discussed that most of the middle class on an average, and this is not a benchmark, but on an average would save out of 100 rupees earned 25-30%, right? At a time like this in the markets, right, you don't want that 25-30 bucks to get lost, even a bit. Like, I don't want to even lose 5 rupees out of that 25, right? So how does one look at investing in the markets, but also ensuring that over a long-term basis, they are in the positive or in the money?
Okay, I'll take your question in a different format. The point being that we are all after this, that what have we saved? That is this 25 and 30%. And this is what is going for allocation. My question is, why is it always income minus expenses equals to savings? Why isn't it income minus savings equals to expenses? Let us first decide how much we want to save. If we decide that we can accommodate our expenses to match whatever is left. Having said that, when we talk of this 25 and 30% of savings that we as advisors go after, it's all about asset allocation and the goals that you have. So let's put it that I need some money, like Dhruv said, say for a 1-year period. It is very obvious that this money would not find its way into a high-risk asset class like equities. So effectively, what are you doing? Basis your goals, basis your risks. All that you are doing is allocation of money in different asset classes which meet your time frames, effectively 1 year, 3 year, 5 year, 10 year, 15 years. And if the asset allocation is correct, over a period of time, I do not believe that any investor would have lost money. And if an investor has lost money, then my humble request would be that kindly change your advisor.
Yogesh, just carrying that point forward, because at the end of it, you'll only invest the money that you save. And how do you make a prudent decision on saving right and then investing right?
I think it's going to be repetitive, that the time horizon, the time is very important, how long you want to save that money for. And based on that, then you decide what kind of instrument, that may be a debt, short-term, long-term, equity or a hybrid product that you go for. And then you understand what is the volatility of that product, like you rightfully said, today's day. Now, what Dhruv said also, I have not received any call from a single client of mine since morning. Our phones are switched off. We are sitting here in this program. The only reason being because all our clients are knowing that this kind of day will come and would come, and what would that affect on their portfolio. So in fact, most of the calls would come as, is this the right time for me to perhaps increase my allocation if somebody is looking for a long-term equity allocation. So the time frame, how long you want to invest for and what is the goal, once that is decided, then you just base it on which product. That's where an advisor comes in to decide whether it's a short liquid fund, a hybrid fund, an equity fund, and then you guide them on what the volatility can be on that product. That what can be the upside, what can be the low side. It's a day like an equity product. What you said, if you put in 100 rupees, it can go down to 90 even the next day. I mean, nobody knew that Sika is going to resign today morning. I guess none of us, including you, I didn't know. So these are things that can happen any day in an equity market. If your client and if an investor is well prepared and knowledgeable on that, then I think there's nothing to worry about.
You know, Harsha, I of course have to ask you about investing style, but being the anchor, I was of course very compelled to ask you about what happened this morning because Infosys is a stock which is core to many portfolios. So we're going to touch upon that later on. But really, saving right, investing right, and then ensuring that the well-invested money grows. You know, what is the right way forward on that front?
Yeah, I think clearly two things are very, very important. One is the asset allocation, and that you need to keep monitoring with your advisor on a continuous basis, and a long-term focus. Because if you don't have any of these two, I don't think you can sustainably create wealth. Since all of you know Sensex, I'll give an example about the Sensex levels. It started in 1979 and we are in 2017. So about 38 years. If anyone had invested just in Sensex and kept changing the composition of stocks as the Sensex composition kept changing and did nothing else, but just stayed invested in Sensex, in the last 38 years, the 1 lakh invested would have been more than 3 crore 15 lakhs, and plus the dividends that you would have received every year. So possibly somewhere around 3.5 crores on an investment of 1 lakh. So I think the key, and in those 38 years, you have seen various events which are much larger in nature, much sharper in terms of correction compared to what has happened today morning. And there will be events which you can't foresee. But if you believe in Indian economy, corporates are going to grow profitably, and you are able to invest in those businesses for a long term, you are actually running those businesses by being shareholders. So that's what you need to think about. And as I said earlier, the key is asset allocation and the long-term focus.
Okay. As a layman, okay, Harsha, if I was an SIP investor in a large cap equity fund, right, which had exposure to technology, and we faced a day like today where, because of a corporate development, one of the stocks where there was key exposure within the fund tanked 6 to 7%. You know, as an investor, I would be like, but is my money safe? Because, you know, that will bring down the NAV of my entire portfolio and my investment, even though I'm investing on a regular basis. So he or she would want to know, what would the fund manager do at his end to mitigate the risk of such knee-jerk reactions?
Sure, you will always have such unforeseen circumstances. It could be at a sector level, it could be at a stock level. So the key to mitigate these is to construct the portfolio in a diversified way where you have everything. For example, if you want a winning cricket team, you can't have 11 batsmen. You have to have batsmen, you have to have a couple of all-rounders, a wicket-keeper and a few bowlers. And even within bowling team, you need to have spinners and fast bowlers. So if you have all of these, then you will be able to perform in different pitches, in different countries, in different conditions. Similarly, a portfolio which is well diversified will have stocks from various sectors at various weights. And the weights are decided by the fund management team depending on what kind of risks they foresee. Obviously, all the risks cannot be foreseen, and hence there could be volatility. But if you are investing for the long term, if you are investing in right set of funds, definitely that risk is mitigated to a large extent. For example, if you are doing SIP in different funds, let's say a large cap fund, a multi-cap fund, a mid-cap fund, and a micro-cap fund, for example. So micro-cap fund is similar to a stroke player in a team. May or may not work at all circumstances, but when he does well, he'll do really well. A large cap is something which is more stable, more sustainable. So you will not have a great scoring rate maybe, but it's more sustainable scoring rate. So you have to have mix of all kinds of funds so that over a long period of time, you will be able to save in different class of equity funds and then get the benefit of potential kicker from mid caps as well as stability from large caps.
Right. Dinesh, do you get a sense that there's confidence building in the India equity market with each passing year? I mean, the number of SIPs registered have been, on the rise. That's a given. The numbers say so. But do you believe that out of the 25, 30 bucks saved by an average middle class professional, that the ticket size being invested in equities via the SIP route is increasing? And are you advocating the same?
There has been a lot of confidence through the SIP route, and investors have matured over periods of time. Courtesy fund houses, courtesy fund houses, TV channels like y'all, and advisors like us, who have gone out in the market to try and explain to people that SIPs effectively murder away the volatility that you face in any equity market. So, having said that, yes, we have seen SIP tickets increase. Today, we have close to, if I'm not mistaken, 4,800 crores every month, which comes in through the SIP route. Earlier, this was in a few hundred crores. The average ticket size has moved up from, say, about 1,500 rupees per SIP to something closer to 4,500 rupees per SIP. But the numbers that we have, I think we address about 1.5 crore SIP investors only. I have a 125 crore population. I have approximately 5.5 crore PAN card holders. I have a huge, huge employed base in this country. And we are not only talking about the organized sector base, there is also the unorganized sector base. So there is a huge opportunity for all of us. And just look at this. Whether the FIIs come today or they don't come today, you have support both from the SIP investor as well as certain institutions like the EPF institutions, which are putting in close to 5,500 crores every month. It can counter any selling. And that is one of the reasons why that in spite of all the risks surrounding these equity markets, we have been able to hold our own.
What's your own sense on between save, invest and grow? The saving part is something that we've addressed. Investing right is something that, over a period of time, it's an evolving culture which, people at large will learn as they go along. Seeing that money grow is a large call on patience. How do you advise your clients and people who come to you or seek advice from you on how they need to keep the conviction going to see their money grow? Because this is not like a fixed deposit, right? That you'll get a 6% return every year, adjusting on tax.
So the first thing is, I think you have to explain that growth is most necessary. I mean, why do you save money? I mean, today an individual can spend all his money, but he does not need to spend all that money. He definitely saves for future, for some needs. And therefore, in future, everybody knows that the costs keep going up. Inflation is a reality. Everybody knows in some way that at whatever age you started something and that costs, 2x, 3x. So whatever money you save, everybody knows that it has to grow. However, in India, as you said, what has been driven so far over the ages has been that I think maybe it is, maybe we were developing or a poor society, security was not there. Therefore, inherent safety was too much. And therefore, the dependence on something like gold has come through generations. And therefore, the first port of call has been always gold, in the families.
Let me do a show of hands. How many out here are invested in gold? Okay, gold ETFs. I'm taking that as a proxy. And how many of you are invested in equities via the SIP route or otherwise? Direct also? Where's the majority investing, I'm wondering?
Correct.
Because we didn't get a majority on either of those options.
So clearly this is a much, enlightened audience, but if you see the whole national statistics or across the country.
But we still have a minority in equity investment.
Yeah. But
maybe they'll change their mind at the end of this panel discussion. So convince them.
So maybe I think if you ask, what is the percentage how many people hold more than 50% in equities? Yeah.
Well, I don't know, because a lot of them don't seem to be in the equity markets just as yet. So I think they need a starting point.
Yeah, so I think that part, that money has to grow. And growth can come only from equities as an asset class. That is a fundamental belief that I try to explain to my clients or whomever I come in touch with. I mean, data is there to show. What Harshad mentioned, that Harsha mentioned that the Sensex was 100 in 1980 and is 30,000 today. What more evidence you need? You compare that with what gold has done. It's pathetic. So what I'm saying is that growth is necessary for, meeting your expenses, improving your lifestyle. And everybody has an aspiration of growth. But what people have is fear. Fear of, the markets falling by 25% or 50%. And I think that is what one needs to address. Explain that the fear is there. And it is because of this, because the market goes down 15%, 20%, then it rises 50%, that it is because of that fear and the investor who stays through that period, that he's paid an extra 5% or 8% over the fixed deposit. You can decide that I don't want this to live with this fear. Then you have to be happy with this 5-6% rate. You'll have a, very peaceful time, but no growth. There's no growth. But it's little like a roller coaster. If you want the enjoyment of a roller coaster ride, but does an accident happen? No, the roller coaster goes up, comes down, goes up, goes down. So the stock markets have that nature. They keep going up, they come down, they go up, but it's an upward moving curve. It's an upward moving slope. So that you're bound to make money over the 10 or 15-year period. And I mean, you can see 20 years data is there in history of the Sensex. You look at the global market, there is 100 years data. But people don't buy data because people are driven by emotions. And that's where the role of, I think, the media, the industry, I think, is to explain to the people. And I think it's very encouraging that the government, after, I think, 60 years of independence, I think the government has woken up that the EPFO can invest in equities. Can you imagine what a signal the government was giving for 50 years? The government itself was saying that equities is risky because EPFO cannot invest in, equities. It's now that the government has woken up. So I think such signals, if the government, in fact, I think it is still shameful that they invest only 15%. Because the employee provident fund, I mean, it is retirement savings, where the retirement savings are going for the next 30 years. I think almost 100% of that money should be in equities. Because that is how, you will protect his retirement, and at retirement, the pension that he gets is adequate to meet his, current living expenses.
But I also want to understand the investor profile of the audience right here. How many of you are invested in fixed deposits? Okay, very few. How many of you think that equity investing in the equity markets is risky? I'm not getting a consensus. This is a bit of a confusing situation. I had a smile when I saw very few hands up investing in gold. And I was like, wow, this is great. We've made some breakthrough, right? And then fewer hands raised when I asked them about investing in equity markets. So it's a mixed bag perhaps, but Harsha, maybe we can help them understand that through the crests and troughs, the market does give positive returns, and fund managers such as yourself take it upon yourself as a responsibility to ensure that you protect the money that's been invested with you. Because if we look at what domestic investors have done all of this year, that's been a show of strength. The kind of money that has come in from domestic mutual funds into the market compared to FIIs really suggests that we are taking, the future of our equity markets in our own hands.
Sure. I think, as you mentioned, the trend has really changed in the last 2-3 years. Earlier, Indian investors were not so positive, or even if when they were positive, they were kind of fearful about investing in equities through mutual funds, and that has clearly changed. Now, the SIP number on a monthly basis is close to about 5,000 crores, which was mentioned earlier, and it's growing at 100 to 150 crores every month. So additionally, 100 to 150 crores is coming into the market. While this number seems it has grown maybe twice in last 2.5 years, it's only tip of the iceberg. Why do I say that? On a population of more than 1 billion people, only we have 1.5 crore SIP accounts even today. And most of the SIP investors have multiple investments. So even if you say people have 3 investments on an average, so it's only 50 lakh people in a country of more than 1 billion people who are actually investing in a disciplined way through mutual funds. I think that number can really go up multiple times over a period of time. Second part of your question, how do we manage risk at our end? All the mutual funds have expertise in terms of researching various sectors, various companies within those sectors. And also there is a fund management team and an execution team who are experts in their own set of activities. They take care of the risks that are possibly there in the market, so that the investors can actually keep investing in a disciplined way and not worry about market volatility. For example, if a particular sector looks less attractive or looks risky, then ideally the fund management team along with the research team decides not to invest or to reduce investments in those set of companies. Similarly, if in our opinion, if a particular set of companies are likely to do better than the overall market, that is where we put more of the portfolio money into. So, and it's not that we are putting all eggs in one basket. Usually most of the portfolios that you see in the market today, whether it's Kotak Mutual Fund or other mutual funds, generally will have a diversified basket of maybe 40 to 60 or even higher number of stocks. And also it will cover a range of sectors. So what you are doing, I mean, a businessman may be running a particular business. He has to run that business until he sells off that investment. So maybe for generations he'll run that business. But as a shareholder through mutual funds, you are actually getting benefit of maybe 50 or 60 businesses. And there is no way, there is no compulsion that you need to stick to those 50 or 60 businesses. The moment you feel that a particular business is not doing well, through your fund manager, you can actually exit those businesses and get into something which is going to work in the newer scenario. So that's the beauty of being shareholders or unit holders. It allows you to participate in a range of businesses that on your own you may not be able to do, but even with a smaller sum like 500 rupees a SIP, you will be able to do that.
Yogesh, as a concept, SIP has picked up. So once a retail investor comes on board, they understand how this concept works, and they perhaps, over time look at increasing allocation via SIPs into the equity markets, into mutual funds. The whole idea behind this investor education initiative is getting the first-timers on board. And a large part of that process has to do with breaking the mindset of seeing investments per se as really being parking your money in real estate, parking your money in gold, or parking your money in fixed deposits. So how do you kind of break that mindset? What do you tell your clients, potential clients in fact?
Basically, it all depends on the age, like you say. Let's say you get somebody young. Initially, it's very difficult for him to first to get him to save. Because that's the biggest issue, because a lot of people spoke earlier about that lifestyle takes away a lot of the income of the young person. And once you get him to understand that part, that he needs to save something for the future, you show the growth of the equity schemes and how an SIP product can really make him get that wealth generated. I'll give you a small example which we give a lot of clients, that if he wants to save an X amount of money, if he saves, let's say it has to save 1,000 rupees for a 20-year period, but the same amount, if he starts after 10 years, instead of 20 years, he has to save nearly 4 times that amount to get that same amount of money. So when we show them this figure, that let's say if he has to save 1,000 rupees or 10,000 rupees today, and he will get the same amount of money after 20 years, vis-a-vis if he saves that money after, instead of 20 years, if he has 15 years, he has to double that amount. And if he starts after 10 years, so if today somebody is 25, if he starts at 10,000, or somebody is at 35, the 35 person has to save 43,000 for the same amount of money, what a person has to save 10,000 today at the age of 25. So when you show that kind of data and statistics and somebody says, yes, there is really an advantage to start young and start early and get that same amount of money. So those are one of the few things that we do show.
Okay, we need to go to the audience for a quick Q&A session. But before that, just a last round of questions. We are here to help our viewers and retail investors understand the benefits of systematic investment plans. And Nikunj and I have coined a term called tip for a sip. So Dhruv, what would be your tip for a sip for viewers watching you?
So my tip is to start, if one doesn't have a SIP, he should start today, SIP should be done every day. There's no day for a SIP day. The moment you get your income or salary, your SIP should be happening, It's as good as what they say, doctors say eat apple a day. So a SIP a month will keep you healthy and wealthy,
Dinesh, what's your tip for a SIP?
Well, it's a SIP till you retire and a sweep out after you retire.
Yogesh, what about you?
I would say the amount of money, everyone has an excuse that, I'll start the SIP tomorrow, to this month, or I'm too young, or I don't have enough, I don't have regular incomes, etc. If you can start a SIP even with 500 rupees a month, and I'm sure everybody can put that money aside, and once you make that mindset that you need to start a SIP, that 500 grows into 1,000 and 1,500 very soon. So please start a SIP. Let not having a PAN card, let not having enough money be an excuse. Start even with as low as 500 rupees.
Harsha, the money comes in your safe hands to be managed and, to help that money grow. So what's your tip for a SIP?
No, I think it's what all the panelists said. I'm just summarizing it. I think start as early as possible. If you have not done it, do it today and have a focus of long term. Don't do it for a couple of years and then stop. Think of long-term wealth and continue investing through SIP on a goal-based target.
All right. Any questions from the audience, please? The lady.
Hello, good afternoon. Very interesting to hear with more than 5,000 crores coming into the market every month. Now my question is, where is this money being deployed? Is the market able to absorb, or is it becoming a case of too much money chasing too few goods? So where is the market expanding? Because, it's been reaching new highs every day. So is it just a liquidity driven market? Because companies' earnings are not really supporting valuations at this level. And another very quick question, mainly everybody talked about large cap and mid cap and multi cap and all. How about taking a contra call in IT and pharma funds? If you could just, shed some light on that.
SIP in sectoral funds.
Yes.
Yeah. As far as market is concerned, partly your observation is correct. It's driven by liquidity rather than just the fundamental factors such as earnings growth or other factors. While macro factors are very, very stable and sustainable today, they are all supportive for a very good economic cycle. But on a corporate fundamental basis, the earnings growth is still missing most of the estimates, partly because there have been few short-term events which have happened, started with previous year with demonetization, which had some impact on the earnings of Indian corporates, later on transition to GST. So there have been a couple of these events which have actually delayed the recovery in earnings for corporates. But our belief is in the second half of this year, we will definitely see earnings growth, earnings recovery happening. Until then, if the money flow continues to be as strong as what it is today, so maybe there will be a disconnect in the short term in terms of valuations and the earnings. Not to say that these valuations are very, very expensive and one should be reducing allocation to equity. But I think if somebody is under-allocated to equity, which is what most of the audience here is, I think there is a good reason to actually go and invest on a staggered, disciplined manner. If you are over-allocated to equity, obviously at higher levels you need to maintain your asset allocation and hence start selling your equity assets. So that's about the first part of your question. Second part, whether to do SIP in a sectoral fund. Again, whether it's a lump sum investment or an SIP in a sectoral fund is going to be more risky than a normal diversified fund, because you're going to be taking concentrated position in a single sector or a couple of sectors. So to that extent, you have to be very careful in terms of selecting that particular sector, whether it's going to work for that long term in terms of the returns. So in fact, ideally, diversified funds offer you better risk return profile for a SIP investor over a long period of time rather than sectoral funds.
On sectoral funds, one thing is very important. They're always cyclical. So, if you want to take a contrarian call, it's very okay. I mean, if you understand the sector, like Arshad said, but one should know when to exit. And our experience shows that a lot of people are not able to exit at the right time, and therefore the experience in sectoral funds is always not as pleasant as diversified. That's a call that one can take.
All right, the gentleman there, can you please pass the mic?
So, it is obvious that mutual funds, the percentages that we have gained since last 2 or 3 years is just because of a lot of retail investors coming in. Still, the ratio is at just 4%, 5% of total investors in India who are just aware about mutual funds and are investing. But if markets get stable due to a lot of mutual fund investors and awareness like this events keep happening, a lot of money pooling in mutual fund industry, the volatility is going to go down because there will be a lot of pooling happening. This decrease of volatility, is it going to show the same returns that they have shown since last 3 years? Because I've entered the industry in last 3 years just for the advisory and I've never seen a low down yet. I mean, portfolios in my advisory are giving 40% returns right now, which is something, if I have got down any investor to invest at 40%, and if this ratio from 4 to 5% of total investors grows to 10 to 12% in next 3 or 4 years, the volatility is going to go down. Mutual funds will not give that amount of returns that they gave in last 3 years. So what would be the effect of more retail investors coming in the market, and will this same performance be there for next 5 years horizon that they have gone in last 3 years?
Can returns be sustained?
I think first of all, past performance is no indicator of future likely returns. So I don't think at any point of time you should base your assumptions of future returns on the past returns. As far as India is concerned, I think it's in a very good shape today. Look at the macro factors. Interest rates are at very low levels. Crude is at 45 to 50 range, which is very, very supportive for our economy. Our current account deficit is under control. Our fiscal deficit is under control. There is political stability. The reforms are happening. I mean, demonetization and GST together, these are reforms which over a period of time you will realize the benefits, but really, really long-term benefits that the country will see. So I think country is making right progress. The question is whether the next 3 years are going to be similar in terms of returns as compared to previous years. I do not think that any expert will be able to forecast future returns. What you need to see is, if you are investing in equity, whether equity is going to give you better inflation and risk-adjusted returns compared to other asset classes. And if you believe that 6-7% is the risk-free return, which is the 10-year government treasury bond return, you should be adequately compensated for the risk that you take in equities. So if you are getting a higher return than this risk-free return, and over a long period of time, obviously every year it will not be the same amount. There will be a couple of years which will be really great, there will be a couple of years which will be bad, but over a period of time, if you make higher returns than a risk-free asset class, I think that's what is going to give you higher wealth and higher spending capacity at a later stage.
I have a very small, simple question. It will help everybody over here.
So, we're going to be
It will help
breaking for
everybody
lunch.
over here. It's a very small question.
So it's
Yeah.
but then yours will be the final question,
Final
because
one.
you're between
It's
the
a
lunch
very simple, and
and
it will help everybody in this room over here. An SIP, if a person wants to start an SIP of 10,000 rupees, what is more advisable? 5 funds worth 2,000 each, or 2 funds worth 5,000 each in different sectors, in mid, small, large, multi-sector, thematic, everything.
Dinesh, you want to take that?
What would be the suggestion?
Good question.
Okay. Basic idea is asset allocation, and if you're saying that this 10,000 rupees is going towards equity, all right, typically we'll just break it up probably into 3 funds. One is a diversified stroke large cap fund, one flexi cap stroke multi cap fund, and one mid and small cap fund. Means it's as simple as that. All right, you just allocate it evenly, and since this money is going to be for 10 years and 15 years, yes, 3 years down the line maybe the large cap will outperform, maybe 5 years down the line the mid caps will outperform, but at the end of the day you will average out at a certain rate okay, which may not be equal to the returns that you have seen in the past.
Quick question for the audience. Do you want to break for lunch or take one more question? Can we take one more question? Okay, great.
How far is it true that if a fund manager leaves a particular fund house, the performance of the fund comes down, just as today it has happened? Mr. Vishal Sikka has resigned and the fund, mutual funds having exposure to Infosys, those NAVs must have come down, I'm sure. So how does one mitigate such,
Event risk.
Events, yeah.
Harsha, you want to?
Maybe he'll be okay. Those, I think a lot of fund houses have learned that the so-called star fund manager days are kind of over with. I think everybody believes in processes, and it's our job as advisors to look at fund houses which have an inbuilt and inherent strong process system, where if any personnel, whether it's a CEO or a fund manager or a CIO, leaves, the processes is what gets the returns and not that individual. And once you have identified such fund houses, they don't make a difference. And you can see even lately a lot of fund houses have had a lot of movements of fund managers and performances have not mattered. Where it is a one single person driven fund or a fund house, there yes, definitely you will have a problem. So those are some of the things that one needs to look at when one is selecting a fund.
Harsha, I just want you to clarify on that because, and I swear this will be the last discussion point. Because a lot of people would associate a fund with a fund manager, but that's not how it works. There's a whole team that decides on stock allocation, which stock to buy, which stock to sell. So by that logic, it's the risk of depending on one guy actually gets mitigated.
Yes, as it was discussed earlier, I think clearly most of the large mutual funds in the mutual fund industry today have a well-oiled research team, which means there are sectors which are covered by experts who are covering those sectors maybe for the last 10 odd years. For example, our own research team, it's a 7-member research team, and they are as capable as fund managers, I would say, in their respective sectors, because the average experience of our research team is about 15 years. Average experience of fund management team maybe a couple of years more, but even research team is equally important compared to a fund management team. Usually, fund managers get recognized because the fund is associated with a particular name, but there is a lot of teamwork which happens behind the scene, where you get research inputs, and the quality of those research inputs, and obviously the management of the fund in terms of portfolio risk and weights, etc., is what gives you the final performance overall. And as far as the mutual funds who are following a certain investment process for doing these things will survive even if there is a attrition of a research analyst or a fund manager.
So God forbid, if you quit tomorrow, everybody's money is safe in Kotak AMC.
Let me say, I'm not planning to quit Kotak anytime now, so that is rest assured.
Of course. Well, thank you very much, ladies and gentlemen. That was the end of the panel discussion, sir. I'm really sorry everybody's breaking for lunch. Thanks very much for being here, and we hope in some small, meaningful manner we were able to convince you to invest in the equity markets through the SIP route, the Systematic Investment Plan route. Thank you very much.
All right, we will resume in exactly 1 hour. Lunch is served to my left. SIP Day will resume in 10 minutes, so we ask that you kindly begin to wind down lunch, and we look forward to continuing with SIP Day shortly. Thank you. SIP Day will resume in just 5 minutes, so we ask that you please wind down lunch, take your seats, and join us so that we can continue with the program. Thank you. Start just momentarily. We're going to start just momentarily, ladies and gentlemen. So I kindly request that you please resume your seats so that we can continue with all that we have planned for the remainder of the afternoon. So for the few that are by the dessert counter, we ask that you please take your seats as we're going to start just momentarily. So ladies and gentlemen, by the dessert counter, we're waiting on you, and as soon as you take your seats, we can resume. Ladies and gentlemen, welcome back to Kotak Mutual Fund presents SIP Day, an investor education initiative with ET Now. even in a day that's been laced with market volatility and breaking news, we have some good news to share, and that's that we've received an overwhelming response on social media with the hashtag SIPDay now trending. And we truly have you, the audience, to thank for that, because we consider you to be a part of the extended SIP Day family. So a huge round of applause to you, our audience, please. And we ask that you please take your seats if you haven't already, as the next segment is about to begin. Now, we've covered some of the do's and don'ts when it comes to investing. We've debunked some of the biggest myths that surround SIPs. And now we wanted to take the conversation in a different direction. We'd like to dissect the disruptions that are transforming the mutual fund industry, that are changing the face of SIPs, and specifically discuss how we as investors can adopt a financial strategy that's future ready. To help us do just that, may I please invite on stage the following guests. National Head of Sales and Product Alliances at Kotak Mutual Fund, Manish Mehta. CEO of Prudent Corporate Advisory, Shirish Patel. Managing Director of Naik Wealth Advisors, Nikhil Nayak. And to help steer the conversation, I'd like to invite on stage Senior News Editor Markets for ET Now, Aisha Faridi. Thank you, Aisha. Take it away.
Hi everyone, good afternoon. I hope everyone's bright and sparkly after the lunch session, which lasted quite a while. So we're here to talk about whether we are future ready for mutual funds or not. Now, you know, we often talk about mutual funds, and you always wonder as to where do you begin, how do you start, how do you de-jargonize. Like for example, when my family watches me on ET Now, they're like, what do you keep talking long, short, put, call, what does it all mean? So today we thought, why not focus on how to de-jargonize, how to simplify, and how to talk about whether mutual funds as an industry are ready to take it to the next level or not. If I have to ask you what has been the biggest innovation that the last decade or two has seen, what do you think it would be? Anyone? Yeah, the gentleman. The thing in your hand. What has been the biggest innovation that we've seen in the last 2 decades, according to you? No, it's exactly what you were holding in your hand. It's been the mobile phone, I think. So, so in this time of technology, how is it that we incorporate mutual funds with technology, and how is it that we make it as simple as maybe WhatsApping or talking on the phone or just checking your Facebook, your Instagram or your Twitter or any other live social media feed? So for that, and to talk about where is the next decade headed for the mutual fund industry, I have with me 3 very esteemed gentlemen. So on my left, Manish Mehta, he's the National Head Sales and Product Alliances at Kotak Mutual Fund. We also have with us Shirish Patel, the CEO at Prudent Corporate Advisory Services, and Nikhil Nayak, the MD at Naik Wealth Advisors. And Manish, let me start off with you. You know, when one talks about whether mutual funds are future ready or not, what is the vision that you at Kotak Mutual Fund have for mutual funds, say, in the next 5 to 10 years? How is the industry going to be? Is it going to be as simple as sending a WhatsApp?
Good afternoon, everyone. So, if you just look at the kind of growth SIP as a segment has been seeing over the last couple of years, just 2016 over 17, the live SIP, cumulative SIPs in the industry has grown at about 30%. At 1.5 crore SIPs, if I was just to use just the math of 30%, then we're talking of anywhere close to 4.5 to 5 crores of live SIPs in maybe 5 years from now. And yes, I think while concept of SIP has been, you know, accepted by the investors, lots of mutual funds, AMFI, all of us are promoting SIPs as the most prudent way of investing. Acceptability is going up high, but I think yes, the time is to even step back and see, are we ready to sort of brace ourselves and prepare ourselves for this kind of flow and investor wanting to come in through SIPs. Yet, I would say we've started making some baby steps in that direction. So just to share with you some statistics that 2016 April, the number of transactions happening online were about 1,20,000. And as of June, that number has gone to about 3,20,000. If you look at transactions being done on mobile, they were about 27,000 in April 16, which is the number now is about close to 100,000. And another very interesting statistics that B15 as we categorize in mutual funds, like all cities beyond the top 6 or 7, 30% of transactions are coming from those small towns using mobiles or using technology. So I think the awareness or the acceptability or just the fact that yes, that's one of the best prudent way of being able to invest, I think is definitely picking up. People are understanding that yes, there are these tools available which can sort of help them make investments easily without not going through the trouble of maybe visiting an office or going to some center where they can deposit a form. And I think as an industry, we are definitely bracing technology or adapting technology in the right way to be able to reach out to more and more amount of people. And I think the same holds true even for our distribution partners who are like working towards that.
And Nikhil, that brings me to you then. How is it that the role of an advisor has changed? How is it that you incorporate technology to help assist people better?
So I think a lot of time, if you go back 5 years back, I think a lot of time was spent on documentation. People needed a lot of assistance on the documentation. So, the processes were a little more cumbersome. And today, I think it has gone, literally gone. I mean, your 60% of time is being saved. But the bigger role that an advisor has to play is controlling the emotions of the client, keeping him on the course, keeping him committed to his goal day in, day out, not worry about what's happening in the market, what's happening, out to the outside world. I think that is the focus that a client has to, an advisor has to bring in. Because I've always said that investments will always make money. But for an investor to make money, he has to be disciplined, he has to stick to his goals and time horizon.
So Shirish, coming to you then, what according to you is the next 5 years in the mutual fund industry going to look like? Is it going to be an aggressive use of robo-advisory? We have platforms right now, you have websites where you can just feed in your data that I want to put in 5,000 or 20,000 or whatever, 10,000 rupees per month. This is my objective. And tell me what are the best mutual fund schemes, a hybrid scheme or a large cap scheme or a small cap scheme is what I'm looking at. Do you sense that there will be more such platforms, more robo-advisory that will come into play?
There are many robo-platforms are coming in the market, but as Manish said that today we have got almost 1.5 crores of SIPs, anticipated to be around 5 crore in next 5-6 years. Definitely technology has to be there. But I don't see that any client straight away going to only technology and doing the calculation and straight away transacting on the SIPs. As Nikhil said, that definitely advisor will play a certain role. So as an advisor, definitely today also if you look at in India, the number of advisors are less. So technology is essential if you want to grow or if you want to be 5x or 10x going forward. So robo definitely is important. As an advisor also, we also incorporating technology. Now today, let us say as an advisor is also using certain technology to assist clients also to know their goals and all these things. So standalone robo definitely would there be a market for them. Definitely it is important if industry has to grow. But I don't see that robo will replace distribution or the advisory completely, because distributors and advisors are also using technology now. So all those things what robo is using, distributors are nowadays using. That is one. Second, all the distributors, like even Nikhil has said that earlier what used to happen, as an advisor, we used to do all the form filling. If you want to update any client, definitely I think it takes lots of time. With technology, I think we have technically, I think we are not doing anything on the documentation side. So now, I think as an advisor, we are free to analyze the portfolio of the client and the advisory becomes better. Third, as an individual person or as an advisor, manually one person cannot deal with more than 100 families. But with technology, easily I think the capability of an advisor to deal with maximum number of clients has increased. So yeah, robo is important. Robo platforms are coming. We also have the platforms today offering the robo advisor and all these things. But distributor or advisor role still will remain. That is what we believe.
Nikhil, at a time when there is such a deluge of data, there are newspapers, there are apps, there are all the social media websites, that are just bombarding you with all the information, and news channels, of course, you know, talking about what's happening in the market on a daily basis, minute by minute account. There is also room for error. Sometimes ignorance is also bliss, you know, and when every day you wake up and you see that, oh, today the Nasdaq has crashed by about 2% and the SGX Nifty is already indicating a gap down start, you wonder what's happening with my mutual fund investments. Or at least, you know, today, if you were holding an SIP in any of the IT funds, you would definitely be wondering what next after Infosys. What are the common mistakes and errors that people make at a time when there is so much information all over?
Yeah, so I think it is important to cut the noise. There are two examples that I'll give. When Buffett was asked about, what's the market view? Yeah, so he said that he's bought there's only one land that he's bought, which is 400 acres. And he said, I never bought that farm looking at the weather channel and what's going to be the weather tomorrow. Because you always take a 10-year, 15-year view for your investments. And you should, I mean, ignore the noise. The other thing is, if you look at in mythology, Ganesha went around his parents and Kartika went around the world. So he was asked why Ganesha won. So he said, Kartika went around the world, Ganesha went around my world or his world. So I think it's important to stick to our world, what is really, really important for our portfolio. And yes, there will be ups and downs, there will be distractions. I mean, the people who are able to ignore that noise, cut that noise, are the ones who have always made more money. So,
okay, yeah, you wanted to add something?
I mean, just to add to Nikhil's point, you know, there is this, I mean, it's a very common thing that if you look at the returns that the markets have given over periods of time and you match them to an investor's return, there is huge disparity. So from 99 till about June of 2016, I think the Nifty returns have been in the range of about 11.5 to 12%. For the same period, an investor's return is 7%. Now, why is there that gap? It's because of maybe decisions at the wrong time that have been taken by them, which has probably resulted to this. And this is one very common feedback which when we go and meet a lot of investors through IAPs, saying that, you know, mutual funds is risky and we have never ever made money. And when we actually sort of think more into it, it's only because you never rode the whole wave.
Yeah, you know, I guess it's exactly like Nikhil said. When you buy a house, not every day you go and check the prices of whether the land price is appreciated or depreciated. So you got to make that objective. Why is it that I'm saving the money? What is my purpose? Is it for a holiday? It's something as short term as that. Is it for my child's education? Is it for my daughter's marriage? And then put that money aside every month. Make sure that you have whatever denomination that you want to put in your SIP, 5,000, 1 lakh, anything beyond that, and just be consistent with that saving, right? Nikhil, you want to say something?
Yeah, I completely agree with you.
Yeah.
So I think I would like to add few points there. As you said, the biggest mistake what the investors are making. Historically, if you look at the volumes in the mutual fund industry, when the historical returns are very, very high, most of the investors will come and start the investments in mutual funds. Lately, let us assume the SIPs are prominent. If you go 3-4 years before, when the SIPs probably for the first time shown the SIP returns last 4-5 years negative returns, and we saw many terminations of SIP. So biggest mistake investors are making is that when the markets are rising, they come in the market. Hypothetically, after a few years, the market is negative. Mutual fund returns are negative. That time they forget their goals and all these things and they start worrying about their investments. And that time, that is the worst time to stop the SIP. So one, I think I would advise investor not to make this mistake, that at least don't stop SIP when the returns are bad or negative. Rather, that is the best time to invest further. Second, every time investors chase the best performing fund. Now today, if I start my SIP, where would I start? The best performing fund, I'll start my SIP today. After 2 years, I'll say that, yeah, my fund is not doing better, somebody else is doing better than that. The investor would stop that SIP and start in some other fund. So biggest mistake I think they are doing is that switching the funds and regularly. I would say they identify the fund which is a long-term horizon. As you said that I think they should marry with the goal. So unless and until the goal is achieved, I think they should continue with the SIP. So based on the market fluctuation, I think they should not look at the SIP valuation. And the biggest mistake everybody is doing is that they stop the SIP when the market corrects. And that is the worst mistake everybody makes.
Yeah, patience pays when it comes to stock market investing. Let's also throw open the floor to any audience questions if you may have for 3 of our experts. Anyone? Yes, go ahead. 1 second, wait for the mic.
Any simplifications coming in future for the KYC procedure, as e-KYC is something which is coming to action, and e-Mudra being the platform used for KYC compliance nowadays, but anything in the future, because when we see SIP are taking, like from an individual advisor point of view, if you go and focus, if you go and advise a client, it takes almost 1.5 months on an online platform, as the discussion is about future ready. So if you are trying to dematerialize your, open an SIP or buy units on a dematerialized mode, it almost takes an horizon of 1.5 months for the client to get on board,
For the paperwork to be
and all of
completed
that to be completed, and SIP to be registered takes almost 30 days at times. Plus, banks are not cooperative at all in terms of SIP registrations. Mandates are a big issue nowadays. They do not want their savings account holders to get down into mutual funds unless it's not a PSU bank. If it's a normal bank, they don't want their money to get pulled out. So I have been facing bank mandate rejections in this world right now, where signatures are something which are prime focus nowadays, where e-Mudra in a fingerprint scanner mode, if linked with Aadhaar, can be a solution.
Yeah,
So
I'm sure Aadhaar will make it simpler. You want to take that question?
No, I think these challenges will always exist, and earlier I said we had some other challenges. So the transactional nuances will remain, and just to make your point, you asked, will it be as simple as WhatsApp? I think it's been simpler than WhatsApp, because today you can't schedule a text or a message on WhatsApp that I want to send a message to my friends 10 days in future, or every month I want to send you can't schedule that, but in an SIP,
It's
you
like
can...
setting an alarm.
Yes, yes.
Stand corrected, yeah.
I think I would like to add a point to answer his question specifically. I agree, I think the KYC is taking a lot of time, and for the new investor, if you want to go from 1.5 crore to 5 crore SIP, we have to address the answer of KYC. There are many platforms available. We are also launching a platform very soon, wherein the client can go to portal, can get the KYC done, and immediately can start the SIP. That is number one. Today also we need the physical mandate form. I think many of the platforms are starting that e-mandate will start anytime now. So without going up even physical mandate also, you can start the SIP in very near future. I think that day you can go all out and talk to all the clients across the world and start the SIP completely paperless and within no time.
Manish, you want to add something?
And just to give you the comfort, even at the industry level, we recognize these challenges, and the industry as a whole, along with the registrars, are constantly working towards how to ensure that these kind of problems are sort of taken care of. And I think as far as the KYC is concerned, even we, as an industry, we've been taking it up with the regulator also, that where you can move to like a seamless KYC procedure, maybe just accept if what the bank KYC is, and that's good enough for us. I've heard that I think IRD has already started adhering to that, even as an industry, and through AMFI. We are also working on that. So we recognize these issues and are also trying to address them soon.
Okay. Anyone else? Yes, the gentleman right in front.
There are a lot of discussions on NPAs with banks. So similarly, debt mutual funds also, they take commercial papers and other investments in lots of companies. Of course, different rated, AAA, AA rated. So how serious is the risk of defaults on debt mutual fund from these companies?
So what happens is, anyway, as far as investment guidelines, like how the regulator has prescribed investment guidelines for equity funds, there are similar guidelines which prevail for fixed income funds also. There is a minimum threshold in terms of rating that they can buy. About a year and a half back, the regulator has also come back and put guidelines in terms of what percentage can we be in a single issuer and what percentage can we be in a particular sector. So with those kind of guidelines falling in place, that sort of, gives, in fact, puts a sort of a rain check in terms of the mutual funds, in terms of investment making decisions. The other important thing is, as an industry, we understand and recognize that, we are managing clients' money in fiduciary capacity. And any slip-ups on decisions on investments in terms of the quality of paper can, completely erode the trust of the investor and the franchise of the mutual fund. So I think with the regulator also now having put in these kind of rules and regulation, I think the industry is very strictly adhering to it. I think even if you look at it from a valuation point of view, the guidelines are very clear in terms of how even a debt paper has to be marked to market on a daily basis, and the NAV represents the true value of that asset. And I think independently, every asset manager has gotten like risk measure, like a comprehensive risk department internally, plus other maybe risk measures in terms of evaluating every such credit before they decide to buy it in the portfolios.
Okay. I hope you were able to answer your question. Yes, the gentleman in the green shirt.
No. Particularly in debt funds, when credit rating of the bonds goes down, in the past 2 instances happened, and debt funds suffered. So in such a situation, how debt funds take care so that the investor's interest is protected?
So again, just taking cue from that answer. So again, in terms of valuation, every portfolio is valued on a daily basis. In fact, most mutual funds would have a credit committee internally with credit managers who sort of are evaluating every risk. As my colleague Harsha mentioned in the session earlier, that there is a team that is there to back him in terms of information, be it on a company, be it on a sector. There are analyst colleagues of ours who keep analyzing balance sheets of various companies. Similarly, most mutual funds also have credit analysts whose job is to keep continuing evaluating every such credit paper that they have in their respective portfolios. And I think it's a constant process. So it's not that, fine, XYZ company is a AA plus, just buy it and keep it, hold it to maturity. We don't need to do anything about it. It's a dynamic process. It's a constant process. And that valuation keeps happening on a more regular basis over there.
But the basic fact remains that you go by the credit rating given by CRISIL or some other, this one.
Not necessary. So rating, you see, regulator has stipulated that rating is a must, that anything that you buy has to have a minimum rating threshold. But I think the industry has evolved just beyond depending upon the rating that is being given to the particular company. There are a lot of risk assessment measures that have been set in internally within asset management companies. In certain mutual funds, like say for example in Kotak, the decision to invest in a particular credit just doesn't lie within the credit team or the investment team of the AMC. It also gets vetted by the credit team of the bank. So that kind of processes have been put in, I think, across the industry level. So I think with fair degree of confidence, I can say that the risk measurement techniques or mechanics that have been put on the fixed income side, that way are very robust.
But your face, what is called, information doesn't depict your credit rating, but you give credit rating given by the credit agencies, credit rating agencies. So if that is so, you should simultaneously give your credit ratings also.
So there are other industry bodies who do that. But we'll move on. Manish, I also want you to highlight as to how simple it is now to make an SIP. And if you have an SIP, the new trends and the new modules which are coming out in the market. For instance, you have a systematic withdrawal plan which is in place. You can top up your SIP, like back in the day, there were calling cards which we used to top up. So just highlight for the benefit of our audience here.
So I think what has happened is yet at even 1.5 crore live SIP book investors, I think we're still skimming the surface. And I think it's traditional SIPs that people have been looking at investing in. A lot of mutual funds have come up with, variants in terms of today. It's not necessary that in case if you want to start one more SIP, you need to start the whole process all over again. You could like sort of top up your existing SIPs because you, especially in the salaried class, you know, where every year with fair degree of certainty there is an increase in salary. One could look to do that. There are variants which are there that in terms of depending upon the P level of the index, one could look at, you know, sort of preponing couple of installments of SIP and putting in a larger amount of money. So you may be investing 1,000 rupee SIP and some very bad news happens and the markets fall to a very low level. There is something called as flex SIP, in which one could, on that particular trigger, up to 3 times or 5 times, whatever the amount you've stipulated, that much of investment would go into that SIP on that particular day. So A, what happens is you're using larger sums of money to buy at a lower rate, and in fact, you know, that sort of is creating more unit value for you. So there are a lot of such variants which are currently available at an industry level. As far as investment is concerned, I think especially now with the ease of transacting through platforms, every respective AMCs have, you know, sort of got enablers on their websites through which an investor or through a partner can invest in SIPs. And I think as far as on the distribution side also, I think the platforms that have been set in are very seamless for transactions.
Nikhil, you were making an interesting point before we got into this discussion as to how an SIP is the exact opposite of an EMI. Highlight that for our audience.
Yeah, so I think if you look at SIP is just reverse EMI. When you start an EMI, if you observe your first few years, you're just paying the interest. And there's very little capital that you're paying off. And then in case of an SIP, if you see the highest contributor in the initial years is your capital itself. There is no return on money that you get. You know, you have to really look at, give 6-7 years in the beginning to build that capital. And then in the end, I mean, towards the end of the tenure, in EMI, it is the interest component which becomes very minimal, and the capital that you pay is very high. In case of an SIP, the last few years, you are actually, your money is working much harder for you, and the large component becomes your interest or the return on the money. So I always tell my clients that if you have to reach 5 crores, first we have to build that capital. First we have to reach 50 lakhs, and then only we can reach 5 crores. And once you reach that 50 lakhs, it's easy to actually then move on to the next level. So.
But you know, it looks intimidating. If today I want to say that, oh, 3 years from now I want a corpus of 5 lakhs as a return on 5 crores, I beg your pardon, as a return on investment, it looks like a very huge sum, and it's a very intimidating sum. 5 crores, really, with that kind of salary? So you just wonder as to how, you know, you need to take those baby steps for you to be able to reach that corpus of 5 crore rupees. And, you know, Shirish, I just want to get you here. Are there platforms which, if I have a target of 5 crore rupees as my objective, which could calculate how much, at what interval do I need to put in SIPs for me to be able to garner that kind of money, 5 crores, say in next 3 years or 5 years?
Yeah, majority of the platforms will give you this kind of goal tracker and all these things. Now let us say, as you said, that I want to reach a goal of 5 crore after X number of years. System will calculate the amount at what kind of SIP you need to start. And again, you mentioned the period also. The system will calculate the amount what you need to start with the SIP with. That is one. Second, also, I think you can talk about the goal. Now, today, let us assume you are talking about kids' education. Now, I don't know 10 years down the line what would be the cost of the education today, but I know what is the cost. After 10 years, what will be the cost? I don't know. But today, I know the cost of the education for the same education. So we also assume the inflation that the education cost might go up by 10%. So today, if you're expecting that medical will cost you around 20 lakh, after 10 years at 10% of inflation, this would be the cost, and for that you need to start the SIP of X amount. So majority of the platforms will guide you that what kind of SIP you need to start today to reach your particular goal. That is number one. Additionally, most of the time I have seen that clients talk about various goals. Now they'll talk about retirement. They'll talk about child's education and all these things. If you look at the kind of amount what they need to reach at that particular level and the kind of SIP what they need to start, the SIP could be higher. So they would say that I can't save this kind of SIP. So that is the first impression that I can't reach my goal. So if you say that I think the SIP is beyond my savings today, I can't start, so at least the baby step is important. The one concept what he said is the step-up SIP. So today, let us assume you need to, as per the goal, you need to start the SIP of 20,000 rupees, and today you believe that I can't save 20,000 rupees a month. There is a concept called step-up SIP. So today you start with, let us say, 10,000 rupees or whatever amount you can save. Based on your salary growth, let us assume even every year 10% salary growth is there. You can decide that every year I can increase my SIP by 1,000 rupees or 10% of the value or whatever. Even if you do with that thing, that the initial requirement of SIP goes down drastically. So instead of worrying about that I can't reach my goal because the SIP value is X and I can't save that, at least you start with whatever amount you can save, number one. And number two, at least use the step-up SIP concept. Unfortunately, today out of 1.5 crore of SIP, what we are talking about in industry, I don't think that step-up SIP would be in FuelX also. So as a concept, most of the investors have learned the concept of SIP, but step-up SIP, I don't think that majority of the investors
People are not aware about it. So you know what to do with your Diwali bonuses. Any other audience questions? Yeah.
Can you highlight on the benchmarking and the criteria with respect to the investment, with respect to the fund managers?
We didn't get your question.
Yeah.
Could you repeat it?
Could you highlight on the benchmarking? There are so many players who are into this SIPs. So is that a benchmark in the Indian industry? That's one. And secondly, what would be the criteria with respect to the fund managers with respect to the investment that we make? So if I have to choose the best fund manager, what should be my criteria?
So, I'll just take cue from what Sirish and Nikhil had to say. Very honestly, when one is looking at, specifically from an SIP point of view, if you look over a period of time, it just really doesn't matter. What is important is to start your SIP and to stick to it. I'll just give you a statistic that 5-year return on an SIP, the best fund has given you an 18% return. The worst mutual fund has given you a 13% return. Now that is the gap on 5 years. If I take other periods of time, that gap is only just getting narrower and narrower. So I think specifically if you're looking at investing from an SIP point of view, I think I would lay more emphasis on the fact that I have to start. And after starting, I need to stick to it. Because today you may take your benchmark as the best performing fund and start an SIP. God forbid, 2 years down the line, some bad news in the market happens. You're not going to look at the benchmark. You're just going to, your emotion will tell you, stop it. It doesn't matter that even at that point of time, he may still be the best performing fund.
Well, I'm sorry to say, but then mutual fund versus the insurance, both are using the SIP concept. Now, I have a number of cases where, people have taken a back step after discovering that the SIP has almost paid a zero value. It's almost the same. Maybe it started in 2009. By 2012, 13, they realized that the value has not increased, and a back step had to be taken to disinvest after 3-4 years of lock-in. Now, since insurance is also, pushing on SIP, and it's not creating that positive image. And how I would define a benchmark is if there is somebody best in the industry. For example, we look upon Warren Buffett as the best investor. So in that context, in Indian industry, if I have to do my own research before choosing the best fund manager, so in that context, if you could enlighten us, I think that will be very useful.
So you're asking the best to tell you how to go about doing the best. But yeah, would you have any take on that?
So I think I'll give you another example, and Manish talked about it, that Peter Lynch ran his fund, and for 26, 29 years or so, the average return was 26%, the average investor return was again 8%. So it is first, actually, the IQ is really not important. IQ is equally important, but EQ is also important, and the emotional quotient is extremely important when it comes to investing. While choosing a fund manager, and I think what one should really look at is, there are 3-4 things that we really look at our end, is how the fund manager has done in bad times. How much risk has he taken? Has he deviated? If he's saying I'm in a mid-cap fund, is he going into a large-cap fund or not? So I think you should really focus more on the processes that the fund manager is following. And it is easy to get that with a lot of information available on various websites. So and not really worry about the outcome, because if the processes are right, the outcome has to be, there are very few,
I would definitely be worrying about the outcome, because that's a hardcore investment that we make. So
again, the point what you said, that the investor started the SIP in 2009 and saw zero returns in 2012. Just check the same scheme, whichever fund, I don't know which fund the investor would have taken. Hypothetically, the same investor would have continued in the same scheme today. Check the value. And there are platforms available. Even you can go to our site also, anybody's site also. Start or calculate the same SIP. I don't know the fund, worst performing fund, let us assume. Assume that at that particular day you started with X amount. If you would have continued till now, see the returns. I am sure the worst performing fund also would have given more than 15% return today also. So, as he said, that emotions needs to be controlled. Now, what we do, 2009 we saw very good returns of SIP, market was down, SIPs are doing very good, has given still very good returns. We started the SIP. As I said few years back, SIP returns for last 4 or 5 years were negative and most of the investors stopped the SIP. That is where I think the investor needs to control their emotions, and that is where probably the advisors will play a bigger role. That you don't get carried away with the negativity on your portfolio. You are talking about a goal of your investment. Stick to your goal. There would be periods. I would say that today, if we check about any advisor or any investor, what is your return expectations? They would say that I'm happy in 12 to 15% kind of returns in any SIP or any investments. But we assume that this 12 and 15% will come in a linear fashion. In SIP or in investments in mutual fund, the returns cannot be linear. If you are expecting 15% kind of returns in the mutual fund, you can't expect that every year my returns will grow by 15%. There would be a period of 1 year wherein your returns could be 50%. There would be a period of 2-3 years when your returns are flat or even negative. So after seeing negative returns of 3 years, there was only 1 year when the returns have become positive. So don't expect the returns which are linear in fashion in mutual funds or in SIP. If you talk about longer term returns, SIP is the best tool because of your averaging this thing.
And you have to remember, mutual funds are linked to market performance, so it's not going to be a consistent return, all the time. It's the choice that you make.
Sorry
to
add one more point. As you said, the best performing fund manager, how to select the fund manager, and most of the times investors select the fund based on the performance. As Nikhil said that he has got parameters of selecting the fund manager. So every advisor would have their in-house selection process. So it is not like today if we recommend XYZ fund or XYZ AMC, simply which fund is doing the best. It is not like that. So as an advisor, they have the in-house process of filtering the funds. So you also rely on the advisor's advice also, and always diversify the risk. Instead of going in one fund, you can go for 2-3 funds.
Is there a benchmark? Could you highlight on the benchmarks in the industry?
So benchmark, you can say the fund which is outperforming the Sensex. I think simple banks, we are sitting in BSE, let us look at benchmark as a BSE. Any fund which is beating BSE, I think is a good fund.
Thank you.
Okay. Yes. The one behind first, I'll just come to you.
My name is Bala, and I want to ask you a kind of a fundamental question. That investing in mutual funds is like a buy and hold strategy, except that I'm not doing it, the mutual fund is doing it. Now, the question that I want to ask is that when I look at your channel, and I'm a heavy watcher of ET now, what I find is that maybe 75% of the time is consumed by day trading, daily trading, all kinds of trading. And the actual time given for this kind of investment is very little, and there's no time given to 10-year investment, which somebody talked about here. Now, I'm a 10-year investment type of person. Now, I'm just trying to ask you whether, and if you take a look at the daily volumes, the actual buying is hardly 5% or 10%. The rest is all trading. So if trading is the name of the game, is there something to be told about how to make money through trading? And are there mutual funds to whom we can give the money and tell them trade, because that's where the money is?
I'll come to the channel questions in just a bit. All I want to say is that, there's a market for all. There's a market for traders, there's a market for people who want to invest in mutual funds for 10 years, and there's a market for people who want to invest in 1 year. If you do watch the channel 24/7, I promise you there's a market for all. And we do talk about investments for 10 years as well. But do you think there could be a mutual fund wherein we could give you money and you could trade for us?
No, so I'll tell you, there is this, I'm sure you must have seen that in a lot of cartoons, which says that a layman investor always buys on the high and sells on the low. So, as long as that keeps happening, I think we're very optimistic about our industry, because one day they're going to realize that trading is not getting them anywhere. And I think, from a tax efficient point of view, I mean,
No,
invest
wait a
and
minute.
buy and hold
Wait a
makes
minute.
sense.
You're just saying trading isn't getting anywhere. Now, do you have any facts to support that?
No. So I'm just taking cue from what Aisha had to say, that see, today there are all kinds of investors. Today, I mean, if you look at it, since morning we've been debating the potential of mutual fund industry, which is so low compared to the financial savings. We're talking about in a population such large as India, we just have about 5 crore people who have invested in mutual funds. So there still is a large amount of investors or potential investors who are either, investing in IPOs, who are only sort of, maybe buying good quality equity shares and wanting to hold them and, sort of keep them till retirement. And yes, there is a set of potential investors who probably believe that by trading on a daily basis, I think that probably is a better experience for me today, rather than trying to, like as you said, your philosophy that I'm a buy and hold kind of an investor. So I'm saying, this market there are all kinds of such investors available.
There's room for all,
There is room
what
for
he's
all.
trying to say.
No, I appreciate that totally. Now, you have the figures because all of you are doing trading as well as investing. What do those figures show? Surely these are two different streams. These are two different businesses. They're being evaluated separately. Which is making more money for you, the trading or the investing?
So all I want to tell you is that the biggest investors in the market, people who we read about, books who have been written on them, they've not been traders. So I think I've answered my question on that one. Anyone else? Yes.
We have heard a lot about FIIs hedging their equity portfolios. Do the mutual funds do the same so that all the ups and downturns are well protected? Do you have any hedging strategies in a mutual fund?
So see, it's not necessary that, see, the regulator permits mutual funds to sort of use hedging techniques as and when they feel deemed fit. So today, if you look at it from a mutual fund point of view, if you see it historically or even today, traditionally, even now, most of the flows of monies which are coming in, either from retail investors or, through SIPs or even lump sum, I think the average age of the money that remains with a mutual fund is definitely long term. Now, if that is the kind of flow of money or the stickiness of assets that we are getting, and I think as an industry, as distribution, everyone is advocating that, it's long term is where money can be made, invest goal-based, invest for the long term. So I think, if you see that way, the volatility of inflow, outflow in a mutual fund portfolio is very, very low. So I don't think that hedging is necessarily the tool that they would want to apply at all point of time. Fund manager may independently have a view depending upon where the index levels are, Sensex levels are. If he believes that, yes, maybe I should look at increasing cash component a bit in my portfolio because I think stocks are overvalued. I don't need to rush into buying them currently. I could probably wait, get to buy the stock or get to buy the company that I want at my price. They may kind of use those kind of techniques.
But they do not use these derivatives or options to protect the profits?
Futures and options is what you
So, sir, you see, as I told you, it's a view of the fund manager at that point of time. They have the enabling of wanting to use FNO in their respective portfolios if they believe that, fine, at this level they may want to buy some protection on the downside, because if they believe the markets are, volatile, they could go down further. I mean, people do use these products available from the portfolio point of view as a hedging tool is available. But unlike, if I compare it to, like as you said, that FII, now see, within FII there's a breed, so there are like these hedge funds, they come with a similar mandate. So there are certain strategies of funds which are there in the market today who probably use this, I would say, more than a long-only fund manager.
Okay. Yeah, right here in front. Can we get the mic to him in the first row?
Would you say something about Infosys, like it tanked something around 10% today? So will it bounce back?
I'm not a technical expert.
So we're talking long term.
Okay.
Yeah.
Thank you.
We're talking SIPs here, not individual stock ideas. But yeah, important question. Watch the channel on Monday. We'll figure that out, whether it'll tank more. Last question, yes, the gentleman at the back.
Sir, ever since attending any mutual fund house presentation like yours and from the best of the best to the worst, there is always one singular advice given is keep investing. When comes the time to sell, to take the money out? Because mutual funds, I believe, have a mandate only to stay invested. The thought came to me actually when the 2008 crisis hit the world and markets tanked 57%. The best of the best fund house and the best fund manager in this very hall, I put a question that you were seeing the market overvalued because the price earning multiple had gone above 25. Today, we are at 25. And we are not seeing any extreme situation like 2008. Normal corrections take the market down by 10, 15, 20 and 30%. If this education is given to the investor and if he can book profit today, come back after 3 months, 6 months, the spread of an average return of 15% as mentioned by your colleague, the lowest 13 and the highest return 18, can be made 26%, which the best fund manager in the world has given for 26 years. I want to just share a thought rather than a question.
But I hope, sir, that in the 2008 crash, when the world markets were crashing, you were investing and you didn't pull out of the market.
We pulled out. We pulled out.
Oh, you pulled out.
And the best of the best fund manager, when the Sensex was 19,300, every day the fund house used to send an email, an SMS and a phone call, sir, markets are looking overheated, be on guard. We went on selling for us, for our clients, but unfortunately our communication did not have the conviction to make even a single man sell 100% and sit on cash because greed overtook fear.
Market is all but human emotion.
That's it.
So, sir, you said it. At 32,000, everybody has the courage and the money to buy.
Yes.
At 19,000, everybody has the money, but nobody has the courage to buy.
Very true.
So it is very difficult, and you know, they say that in the stock markets, 93% of the people lose money, and their losses accrue to 7% of the people.
Perfect.
And these are the people who can actually, like you said, you could not even convince one single client to be on 100% cash. So
the max was 95%.
Yeah. So I think, we are talking about SIP today. I'll give you another example. If you had started an SIP on Jan 2008 at 21,000 levels, okay, and if the client had continued or an investor had continued till August 2014, that's when the markets went down from 21 to 8.5 or whatever, I don't remember, and then went back again to 21,000 by August 2014. So the investor would have made zero money in Sensex, right, 21,000 to 21,000, but the SIP would have given him 10% returns.
Yeah.
And I think that's what is really needed. You need to actually cut off yourself for certain portfolio. And just to answer the other gentleman's question, trading maybe could be needed or could be used by some investors for some part of that their portfolio. Maybe you could see that when 75% of the time we talk about trading, you could use it for 20% of your portfolio, but 80% of the portfolio has to be invested.
Buy and hold.
Yeah, yeah. And to answer your buy and hold, I mean, the richest investor in the world has has gone on record and said that our favorite holding period is
25
forever.
years.
So, and you look at the wealth that he's created.
Terrible.
And there are a lot of old people that I see in the auditorium, and I just want to give you one more analogy. At 60, at the age of 60, Buffett's net worth was 3.2 billion.
Yeah.
At 84, he is at a completely different level. So the life began for him at 60, and that's what power of compounding long-term investment has done to him.
And that it's never too late.
Absolutely.
So start your SIPs today for all those who haven't already. Unfortunately, we're running completely out of time, so we're going to take the queries later. I'm going to thank our panelists and thank all of you for being such a great audience. Thanks so much.
The insights that the panelists just shared were such a rich reflection of both their personal and professional experience, and we thank them for that. Now, it's been said that the cornerstone to a successful investment strategy is time in the market and not timing the market. So to put everything into perspective, next we'll examine the global and local market movements that we're subject to as investors and understand how a systematic investment plan can help us weather and withstand the volatility. To impart his insights, may I please invite back on stage Managing Director of Kotak Mutual Fund, Nilesh Shah.
Hi, a very good afternoon to all of you. And this presentation is a lighter vein presentation. We'll try to sum it up whatever you have learned during the day. The first question which invariably comes, is this the good time to start SIP? What is SIP? How to do SIP? And so on and so forth. So first question which we have to answer, why SIP day? And it actually came from Valentine's Day idea. I saw everyone celebrating Valentine's Day, and I thought, why not celebrate SIP Day, especially in the month of independence, so that we can help make people get independence from financial worries. And it is probably less relevant in a city like Mumbai, but even in a city of Mumbai, you do get people who haven't learned from this. All of us have been brought up saying that money is not everything in life, money is not important. But I have found that compared to my parent, Warren Buffett's advice is far better, which said that money is not everything in life, money doesn't matter, but make sure that you have made enough money before you make such statement. And there are so many people who today don't have independence from financial worries. They could be dabbawalas, they could be policemen, they could be soldiers, they could be firemen, or they could be common men like you and me. And that's where we thought, let's try to popularize SIP Day like a Valentine's Day, and hopefully it will become part and parcel of everyone's life. Why did we focus on SIP Day? Because we learned from this gentleman. Everyone knows about him. He is the greatest cricketer of all time. 18,000 plus one-day runs, 15,000 plus test runs, only meant to score 100 centuries. What is the secret of Sachin Tendulkar? I think in one simple word it can be described that he started playing at the age of 16 and continued to play till the age of 40. He started early and stayed longer. This is exactly what you have to do in equity market. Imagine if Tendulkar had started playing at 26 years of age. Would he have been Tendulkar? With all his talent, with all his commitment, with all his capability, he certainly would not have become today's Tendulkar if he had started 10 years late. That's what equity market also teaches. If you want to be Tendulkar, start early, stay longer. Warren Buffett is equivalent to Tendulkar. He started making investments in equity market at almost 16 years of age, and his only regret in life is that I started late. So, start early, stay longer. The next question then comes that not everyone is Tendulkar. Of course, not everyone is Tendulkar. But look at Tendulkar. How did he become Tendulkar? He could have easily become Shahid Afridi. He played 29,437 balls in test match to score only 15,000 plus runs. Out of this 30,000 odd ball, on probably 12, 13, 14, 15,000 ball, he didn't even score a run. He just saved his wicket. And out of 30,000 ball, maybe there were 3,000 balls or 4,000 balls which he hit for 4s and 6. So you don't get to hit 4s and 6 even if you are Tendulkar. And in fact, you become Tendulkar by saving your wicket for as long as possible, which is what you have to do in stock market, which is what SIP does for you. The power of compounding is best illustrated by this grandma's tale. There was a Brahmin who went to a king and asked for dakshinas. And king, in his ego, said that demand what you want. And he said, very simple thing. I want you to give as many, pockets of rice which will fit on a chessboard. And the king said, surely I can give that. But he said, there is only one condition. At every next bracket or next pocket, you will square the rice given in the previous pocket. And the king agreed to it. And see the calculation. In the first pocket, 1 rice was there. In the second, 2, then 4, and then it kept on increasing. By the time he reached 64th, it became so much that the king could not have honored his promise. That's the power of compounding. And it is best illustrated in this formula, where if you had 5,000 rupee SIP on a monthly basis at 15%, and you could maintain that kind of track record, in 10 years, that 60,000 rupees a year will grow to about 13 lakhs. In 20 years, it will grow to about 66 lakhs. And in 30 years, it will grow to about 2.78 crore. That's the power of compounding working in your favor. And as in the morning Nikunj mentioned, the power of compounding is best illustrated by world's most intelligent person, Albert Einstein, who said that compound interest is the 8th wonder of the world. Those who understand earns it, and he who doesn't understand pays it. So let the power of compounding work for you by staying longer on the equity pitch, by staying longer in the equity market. Instead of timing the market, try to put time in the market and you will make money. The next question comes, when to start? And let's look at MS Dhoni. He is one of the batsmen who have virtually played at every position in the cricket game. And this is his record. Sometimes he has opened, still strike rate of 86. Sometimes he has come 3rd, 4th, 5th, 6th, 7th, 8th. Across the position, his strike rate has more or less remained the same. It didn't matter when Dhoni came to bat. All it mattered was what was the target and how do I pace my inning. That's how he has become one of the greatest finisher in the one-day cricket. In SIP also what matters is your attitude, not when you start. Today is the best day to start if you haven't started. If you could go back into time, of course 10 years back or 20 years back was the best time to start. But all of us don't have time machine. So we have to learn from Mr. Dhoni, no matter what positions we are given, today, yesterday, tomorrow, we just have to make investments and stay invested. What about the risk of market timing? There are many people who say that I will invest if market corrects. Now please remember that most investors have lost far more money waiting for correction in the market than actually when correction happens. If you see the history, people are still waiting for corrections to come at 1,000 Sensex, 5,000 Sensex, 10,000 Sensex, 30,000 Sensex. And in that waiting, they have lost far more money when Sensex actually moved from 30,000 to maybe 16,000 or 17,000. And this is what is illustrating again the same point, that if you had invested roughly about 5,000 rupee a month or 60,000 rupees a year for 20 years, and in one installment you made right at the bottom of the stock market, in other installment, in other SIP you make the top of the stock market, the return differentiation is not huge. If you invested at the peak of the stock market, always your return is 11% compounded. And if you invest absolute at the bottom, your return is 14% compounded. Just 3% difference for trying to time the market, and all of us know that no one knows how to invest at the bottom, no one knows how to invest at the top. You will always be average, and hence the return differential is not going to be significant by trying to time the market. What if we try to time based on days? Whether you do it on the 1st of the month or the 20th of the month, the numbers remain the same. It doesn't change. So instead of timing the market, just try to spend time in the market. There is this gentleman whose average is one of the highest in one-day international, 53.58. His name is Michael Bevan. Like Mahendra Singh Dhoni is the finisher for India, he was the finisher for Australia. Unlike Dhoni, who is known to hit sixes at will, Michael Bevan hardly hit any 4 or 6, and yet his average is 53.58. What did he do? In my parlance, he did SIP in one-day international. He was always milking 1 run, 2 run, 3 run wherever possible. When there was no run, he will run fast to score 1 run. When there was 1 run, he'll run faster to take 2 runs. And by milking those 1 or 2 runs extra, he kept on scoring more and more runs. He kept on finishing matches for Australia. And invariably he remained not out, which resulted into his one-day average becoming 53.58. This is what SIP does for you. It just allows you to run, it just allows you to finish. You don't get 4 or 6 like buying a stock and going into 10 bagger, 20 bagger, but it just allows you to compound in, maybe lower single digit, lower double digit sometimes, higher double digit sometimes. If you had done SIP of, let's say, 10,000 rupee per month in Kotak Emerging Equity Fund, which is our small cap fund, and it has done extremely well, in last 5 years, 6 lakh rupee invested over 5 years would have grown to about 12 lakh rupee, giving you about 28% XIRR. And instead of SIP, if you had invested a lump sum investment 5 years back, that 1 lakh would have become roughly about 3.3 lakhs, giving you roughly 27% CAGR. So if you see the lump sum investment versus SIP over a longer period of time virtually starts delivering similar return. No one can time the market, so it's far better to do SIP rather than going and wasting time and energy on timing the market. Should you be doing SIP on a single stock, or should you be doing SIP on a mutual fund or a portfolio? If you are doing SIP in a single stock, you have to ensure that your stock is like Tendulkar. It will continue to deliver through ups and downs. If you have ability to pick up Tendulkar, surely go and invest in a single stock. But if you don't have that ability, which we don't possess, go and pick up the mutual fund portfolio, go and pick up a diversified portfolio. It will have some batsmen, some bowler, some wicket keeper, some all-rounder. Combination of that will deliver return. Form is temporary, class is permanent. Virat Kohli, he today has world's highest average in one-day international. But he has also got out 11 times for 0 in one-day international in his short career. But that doesn't mean anything to his stature as the finest batsman of one-day international. SIP also will deliver ducks for a short period of time in your investment horizon. But if you give them enough time, it will come back and it will start delivering return. SIP in that sense is like a tapasya. You have to pray for a long enough period of time to get the vardhan of Lakshmi Mata. SIP in some sense is like a bamboo tree. You have to invest, and for years you may not see any result. But one bull market and that SIP tree will grow like a bamboo tree. SIP is like your regular medicine. Some of you might suffer from blood pressure or cholesterol or diabetes, and doctor would have prescribed you certain medicine. And normally all of us take 1 medicine a day or 3 medicines a day. We don't take 365 days medicine in a single day to cure ourselves of diabetes or cholesterol or blood pressure. SIP is same thing. You don't put money at one go, you take installments. The value of advisor. If SIP is such a commonsensical, simple concept, do you need an advisor? And as Nikhil and Shiris were there, you do need an advisor to pick up SIP in a equity mutual fund, because today there are more than 500, 600 mutual fund schemes. And within schemes there are multiple plans. If you choose an advisor, your journey will be simple and straight. If you don't choose an advisor, you will get confused, and maybe you'll end up doing SIP in a scheme which is not performing well. So when you are starting an SIP, do take care to ensure that you have someone who is holding your hand towards right schemes, right product. These are all the statutory disclosures which we have to make. But most importantly, this is the message from Gandhiji. He was a Baniya, quote unquote, and what he said was, don't bother about daily Sensex movement, don't bother about hype and noise, don't bother about tips. No one in the world is interested in making you rich by giving you free tips. In fact, it has been now proven in few cases that people who come on television giving free advice end up recommending you to buy something when they want to sell, and end up recommending selling you something when they want to buy. What Gandhiji's message was: long-term investment, regular investment, and asset allocation. These are the surefire way to get independence from financial worries, and SIP is a beginning. Once you get accustomed to SIPs, obviously there are many more instruments and tools which you have to use, but for beginners there's no better instrument than SIPs to get out of financial worries. These are all the risk factors. Please don't bother to read them, otherwise you'll never be able to make investments in financial instruments. Thank you very much for your attendance. We hope that all of you will become Kotak Mutual Fund SIP customers. And if you have questions, we'll be happy to take that. You are asking a question in front of ET now. So what I am saying is that, yes. So don't stop watching television channels. But from those television channels, you have to pick what is appropriate for you. So television channel will bring long-term investors like us. And, I'll just share an example of my daughter. She's now in 9th standard, but when she was in 5th standard, one day she came to me and said, Papa, I want to go on television. So I said, Beta, you have to study. You can't go on television like this. So he said, what study? For years I have seen you on television, and every time you answer, no matter what question is, that in the short term markets can go anywhere, but in the long term everything will be all right. I'll also repeat the same thing. So फिर इज्जत का सवाल हो गया कि अभी तो बेटी ने अपना पोल खोल दिया. So you have to pick up what is appropriate from the television channels or from media. There are shows which will talk about how to trade. If you are a trader, please listen to them. There are shows which will talk about how to invest. If you are an investor, please listen to them. There are talks which will bring a boardroom into your bedroom. Like today, what's happening in Infosys is visible to every single investor across the country. If you are a shareholder of investor, if you want to invest in Infosys, it is worth seeing the television. But please don't confuse between trading and investment. Most of the time, a failed investment, a failed trade becomes investment. In our philosophy, in Diwali days, we have a Kali Chaudas. On Kali Chaudas, we try to take kachra out of house. That is the tradition in Gujaratis and Marwaris. The real intention of the tradition was to take the kachra out of portfolio also. Today also, if you go to someone's house, he will still have shares of Square D Software, Pentamedia, and so on and so forth. So use Kali Chaudas to clean the portfolios.
Thank you.
So taxation-wise, government has been very kind to SIP investors. Farmers and equity investors are the most preferred customers of Government of India. On agriculture income, there is no tax. On long-term capital gain in SIP, also there is no tax. So any SIP investment which you hold for more than 12 months will give you tax-free income. You can't get a better deal than this.
Sir, for retail investors, what would be the parameters that you would suggest in picking multi-bagger stocks? For example, Mr. Ramdev Agarwal from Motilal Oswal has come out with this wealth creation study explaining QGLP, quality of the business, growth, longevity, and price, good multiple. For example, Podunju sir would have his own thing, Vijay sir would have his own thing, Ramesh Damani sir would have his own thing. But universally, for retail investors who want to do it on their own, what would be the parameters that you would suggest in picking good stocks? Sorry, I have another two questions. The other two questions are what are the broad sectors or themes that you would suggest in investing at the moment, because FMCG is not doing well because this destocking of GST, IT pharma stocks with a falling rupee, with a rising rupee rather, and even the banking stocks with the stressed assets NPA. So which sectors would you suggest in investing at the moment, whether infrastructure or any other sectors? And third thing is, what is your perspective on the Indian economy and the Indian growth story? Because I've been hearing a lot of fund managers, Mr. Sunil Singhania, Shankaran, Naren, Prashant, and they've been very bullish on the Indian growth story. They've been saying that the economy is going to double in another 6-7 years. So what is your perspective on the Indian growth story?
Sure. So one, how to pick multi-bagger stock. You have to learn from Eklavya. He became the best archer of the world by keeping Guru Dron's murti. So you can keep Ramdev Agarwal's murti in front of you and start reading balance sheets, start reading like him Warren Buffett's book, start practicing in the market. If you fire 100 shots continuously, 101st shot will be perfect. So there's no shortcut to success. If you want to become like Ramdev Agarwal, if you want to become like Nimesh Bhai, if you want to become like Rakesh Jhunjhunwala, one, you must have luck like them. Second, you must have skill like them. There's no shortcut over here. You have to read thousands of balance sheets. You have to meet hundreds of management. You have to understand the macro trends, micro pictures, and you have to put appropriate money. There are many people who have bought Infosys at 100 rupee on listing, but they sold out when it went into discount. There are many people who bought Kotak Mahindra Finance on listing, and for 10 years Kotak Mahindra Finance didn't deliver any return to the person who bought on the day of listing. Many people got burnt out, they got tired, they sold out. And from those points, Kotak Mahindra Finance has been a multi-bagger. So what you require is discipline, skill, luck, all combined. Investment is an art, it's not a science. You could play lefty like Saurav Ganguly and still score a century. You can play like Virendra Sehwag righty and still score a century. You can be like Rahul Dravid and still score a century by tiring bowlers out. You can be like Virendra Sehwag and hitting people out of 4s and 6s, you can still score a century. So there is no one perfect style. Do what is appropriate for you, but without putting that hard work, there's no shortcut. If you just buy what you hear Rakesh Jhunjhunwala is buying or Ramdev Agarwal is buying, will that give you money? The answer is quite likely no, because when the tide turns, you may not have the patience to withhold those stocks like those guys. They will buy more when price is correct and if fundamentals haven't deteriorated. Most retail investors will follow the price and sell rather than buy. The second thing is broad theme on which markets can run. So there is something called 3x3 equation. You have to buy good businesses at good prices which are run by good management. So there are 3 quadrants: good, bad in terms of business, good, bad in terms of management, good, bad in terms of price. If you are buying a bad management in a bad industry at a bad price, only your luck can give you money. You need to have another stupid who will buy from you that junk. But if you buy a good company at good price in good industry, you really need to be unlucky to lose money. Only your stupidity or foolhardiness in terms of trading can create losses over there. An investor is unlikely to lose money in a good industry at good price with a good management. Now, how do we define good and bad industry? You always want to invest in that company which is returning cash to you rather than taking cash from you. So there are companies like Sundaram Finance Limited. Once they came out with IPO, they never ever raised capital from public. That's the best business. Stay invested because they'll keep on returning cash to you. That's good industry. How do you define good management versus bad management? A good management is someone who is bothered about minority shareholders, who doesn't take money out of his company, who doesn't take shortcuts to increase his value at our cost. What is good price or bad price? Good price again is an art, it's not a science. But if you can buy something at a price which is relatively cheaper compared to what market is pricing in terms of growth, is a good price, otherwise it's a bad price. So if a company is available at 60p, market is pricing in that it will continue to grow at, let's say, 40% per annum for next 10 years. If you believe it's going to be 50% growth, then it's a great buy even at 60p. On the other hand, if there is a company available at 10p, but market is pricing it to grow its earnings only at 5% per annum for next 10 years, and you believe it will actually degrow profit rather than grow profit, then it's a sell even at 10p. So good valuation is relative. Good industry is based on ability to return cash. Good management is based on their past behavior as to how they have protected minority shareholders. You put these three things together, you get a winning formula, but you still require hard work to execute on the ground. The third thing is about Indian economy. I mean, when I started my career way back in 90s, Indian economy was 250 billion. Today it is 2,200 billion. So we have almost grown 8.5 times. And because we have grown 8.5 times, our markets have moved from 1,000 Sensex to 32,000 Sensex. Now the call is, from here what? If we go by international expectations, we go by domestic expectations, the expectation is that over next 10 years, this $2.2 trillion economy can become $4.4 trillion. This is almost doubling of current economy in a much shorter period of time than what we have taken to reach here. So whatever we witnessed in last 30, 40, 50 years will get repeated in just next 10 years. There will be new sectors, new companies. There will be some old companies which will become very big. But you will see almost same wealth creation which you saw over last 30, 40, 50 years in next 10 years. And that's your opportunity. I don't think so generation before us will witness this kind of growth. I don't think so generation after us will also witness this kind of growth. We are the most luckiest generation to see this kind of transformation where Indian economy is multiplying 10 times. Yes,
I must take this opportunity to thank you. You have been a pioneer in popularizing SIP Day. I was talking to one of the ET Now anchors, and I remember the first time you had it, and it's great, and the audience is so receptive, and the hospitality has been really very nice. Thank you. Very, very quick question. I mean, this year has seen a lot in Nifty and Sensex scaling new heights very, very fast. Like, 9 to 9,500, 9,500 to 10 was like in the blink of an eye, And where do you see, end of this year, 31st December, where do you see Nifty and Sensex? Just,
So you have asked me 31st December, not the year, right?
No, 31st December, because we all need to party.
Perfect. So 31st December, it will cross 1 lakh. Just don't ask the year.
Good. I'm ready to party.
The
Thank you.
reality is that no one has ability to predict Sensex. When the last crash occurred in Jan 2008 to October 2008, I mean, at 21,000, we knew market was expensive, but we had no idea that it will correct it to 8,000. And right on 8,000 Sensex, there was a Economic Times event where 5 of us were present, me, Nirmal Jain, Ridham Desai, Rakesh Junjunwala, and one more gentleman. And 4 of us obviously were bruised, battered. For days we had worked, 24/7. And we were really dejected at ourselves looking at 21,000 to 8,000 journey. And yet on that day we went out telling people that you should invest. Somewhere this is the bottom of the market. Now things have become very, very cheap. You are able to buy stocks at 2p, 5p. You are able to buy stocks at less than cash on balance sheet, and so on and so forth. Obviously, on that day in audience, there was no impact because people had only seen in last 8-9 months, we losing 50-60% of their value. There was another gentleman whose name I'm not naming. He was the guy who was saying that index will go from 8,000 to 6,000. And the whole audience was captivated by him because everyone just extended what happened in last 8 months over next few months. And normally once the panel discussion ends, people come to meet. That was the day when all 4 of us were standing on one side consoling each other, and he was there with center of attraction. Fair enough. Over a period of time, God has been kind. From that day, Sensex never went below that 8,000 level. So we don't have ability to predict market. We have ability to pick up trends. And if you keep on doing SIPs, then maybe you will invest at the top, you will invest something at the bottom, and over a period of time, compounding will start working in your favor. Let's assume that Indian economy stagnates and market doesn't go up as we are expecting. Even then, top-up SIP will start working in your favor. After doing SIP for 3, 4, 5 years, you will also develop that ability to top up SIP when markets are cheap or at the bottom and reduce SIP when markets are at higher level. Even that combination will still deliver you higher return. So SIP is the stepping stone. Go for then higher levels to increase your portfolio return.
Great, thank you.
Can you give that?
Hello. So, we wanted to know about this the domestic mutual fund as the industry and international FIIs, what we have been getting. So far, what is the disproportionate ratio? And with the new pension plans and provident funds and lot of, how much depth you see so far and in future to match that, and how Indian citizens or Indian people can benefit out of this prosperity, what we are going to see. Thank you.
So one thing, if we see globally, pension funds are the largest owner of equity in most developed world. Now normally we always believe Gora is always right, but somewhere in copying Goras on their pension fund management, we are 15-20 years late. We allowed PF fund to invest into equity markets somewhere in 2005 or 2006, but they started investment only in 2015 and 2016. Now, to succeed in equity investments, you need to be a long-term investor, you need to be a regular investor, and you need to do asset allocation. PF Trust by definition is a long-term investor because they have to give retirement money after 15, 20, 30 years. By definition, they become regular investor because their monthly flows keep on coming. And by definition, they have to do asset allocation because government has prescribed certain asset allocation on them. So by nature of their constitution, PF Trust would have become successful equity investor if they had started investing. Better late than never, now they have started investing, and that's giving might to domestic mutual fund. Today, if you want to sell an IPO, you just have to go to Bandra Kurla complex, Lower Parel, Nariman Point, and maybe in Chennai. That's it. You don't have to go to Singapore, Hong Kong, London, New York to sell your IPO. Domestic mutual fund this year have invested more than the FIIs. We have invested close to 60,000 crore. FIIs have invested close to 55,000 crore. In October, November, December 2016, when FIIs had turned sellers pre and post demonetization, mutual funds were buyers, and that's why market didn't correct as much as it otherwise would have corrected. So from a flow point of view, courtesy the PF money, courtesy the SIP money, mutual funds are almost equal to FII this year, and they were much bigger last year. From a size point of view, the FIIs are still 4 times bigger than mutual fund. We own about 6% of market cap. FIIs own about 24% of market cap in top 200 companies. And if we get few more years, my feeling is that we will start meeting FII along with insurance companies in terms of size. Today 6% is with mutual funds, 8 odd percentage is with insurance companies, 8 plus 6, 14. FIIs are at 25. In few years we'll catch up with them. That will bring stability and less volatility to Indian equity market. We have seen time and again in many emerging countries when FIIs move out, they take all the three markets of debt, equity and currency down with their exit. Because they start dumping, currency depreciates. Because of that, some people start selling their debt, some people start selling their equity. Combination of this creates a vicious circle where falling currency, rising interest rates, falling equity market kind of derails all the three markets. If we have domestic mutual funds and insurance companies which can stand against FII in equity market, if we have Reserve Bank of India standing against FII in currency market, if we have Reserve Bank of India, LIC, insurance companies, banks standing against FII in debt market, then to that extent we will be able to withstand their outflows in a reasonable manner. Our volatilities will come down and our markets will become more safer. Sure. So what is PMS? Yeah. The question is, should we go for PMS as recommended by some of the advisor or not? So PMS suffers from three inherent limitations. Every time I sell in a mutual fund, I don't pay tax. Every time I sell in a mutual fund and if there is a profit, you pay 15% tax. So trading in PMS is 15% less profitable by virtue of tax compared to mutual fund. Second, in mutual fund I can get anchor allotment in IPO, I can get allotment in QIP. In PMS I don't get that. So I don't get bulk quantity at the same price. Third, from an operational reason, not from a legal point of view, but from an operational reason, in mutual fund using derivatives is much more easier. In PMS using derivatives is much more difficult. So because of these three reasons, it is likely that PMS will underperform on a standalone basis vis-a-vis mutual fund. So how do I add value to PMS? I add value by taking concentrated risk. I add value by going into small and micro and mini caps. Now this makes PMS service better return, but please remember it comes at a higher risk. So if your risk return permits, you could go into PMS, but if your risk return is not permitting, then please don't come into PMS. If you are a fresher, please start with large cap mutual fund first and then only come into PMS from an equity point of view. If you are total fresher, first start with an income fund or an arbitrage fund or a liquid fund where your experience will be more positive, then go into hybrid schemes and then finally move towards equity schemes. So you need to manage your risk return profile before jumping into the product. PMS is suitable for higher risk, higher return seeker. It is not meant for conservatives. It is not meant for low risk takers. Yeah. Sure. So one, don't try to analyze too much of data, because let's assume I have an equity fund and I have an arbitrage fund. I bought HDFC in my equity fund and I sold HDFC in my arbitrage fund because my arbitrage opportunity was limited. Now these are two different trades. When you see data, you see Kotak Mutual Fund selling HDFC, Kotak Mutual Fund buying HDFC. But these are for two different purposes. One is an investment call, one is an arbitrage call. They are completely independent. Similarly, when you see a fund house selling versus fund house buying, a fund house may have bought HDFC because they have subscription. A fund house may have sold HDFC because it is redemption. What is important is that compared to benchmark how much HDFC I own vis-a-vis how much I don't own. So if the person who is selling HDFC, he still has a, compared to benchmark weightage, higher HDFC allocation, then he's bullish HDFC despite his selling. He is selling probably to meet redemption. If a fund house who has bought HDFC but his overall weightage in that scrip is lower than the index, then he's bearish HDFC. He might have just purchased something because he needed to deploy his cash. So don't look at the trade, look at the position. Ma'am, can you use the mic? I couldn't hear you properly.
So can you please enlighten us about balanced funds with dividend options for retirees who can get some income every month?
Sure. Sure. So ma'am, balanced funds dividend does not necessarily come from income. It can come from your capital also. So for example, I have a balanced fund whose NAV is, let's say, 100 rupee, even though its face value is 10 rupee. And when you invest at 100 rupee, it would have some ability to declare dividend. So I can keep on declaring dividend from that surplus, even though I may not have earned anything on that 100 rupee. So please remember that dividend in an equity fund could come out of income or it could come out of capital. As a retiree, you don't want money to come from capital, you want money to come from income. Now in today's level, for retirees, it makes sense to invest in balanced fund. But tomorrow, God forbid, if market gives a correction, then of course your balance will not fall as much as an equity fund, but you should take the advantage of this correction and move from balanced fund into pure equity fund. Please remember, when 100 becomes 10, you are down 90%. But when 10 becomes 20, it is up 100%. When 20 becomes 40, it's another 100%. When 40 becomes 80, it's another 100%. And 80 becomes 100, it is 25%. And if you can pick up from 10 to 100, it is up 900%. So on the way down, you lose 1. On the way up, you can make 10. So try to take advantage of market volatility by moving from balanced fund to pure equity fund to pure mid-cap fund, so that on the way up, you can cover for your losses and you can make more money. That was the last question, so we can probably discuss after this. Yeah?
Sir, we kindly ask that you please remain on stage. We have so much to thank you for, the time that you spent with us, your incredibly inspiring words, and a presentation that so many of us could so beautifully relate to. So another huge round of applause for Nilesh Shah. And among all of you in the audience, we have two very lucky individuals with us who participated in the SIP Day contest that was held by ET Now. And I say lucky because both of these individuals will receive the opportunity to have their investment portfolios personally designed by Nilesh Shah and ET Now's Executive Director, Executive Editor, Nikunj Dalmia. Is Nikunj with us? Is he in the building? Nikunj, please join us on stage to help us do the honors. And as I announce the winners, I ask that they please join us on stage. In no particular order, our first winner is Makarand Khandekar. Huge round of applause, please. And our next winner, Paresh Dholu. Huge round of applause, please. Gentlemen, congratulations again, and now you may all return to your seats. Thank you so much. To wrap today, I'd like to invite the National Head of Sales and Product Alliances at Kotak Mutual Fund, Manish Mehta, back on stage to deliver a vote of thanks. Ladies and gentlemen, please put your hands together.
Hi, good evening everyone. So I hope you all have had a good day, good session, and I think the panel discussions that were conducted today were very, very enriching. I think right from the panel discussion on wanting to make women financially independent and take charge of investments besides taking charge of households, I think that was very, very interesting and good to hear the perspectives that all our panelists had to share. I think the panel on Save, Invest and Grow, I think there were some very good insights that Dhruv had to share in terms of investing for the long term. Harsha shared his views on the whole investment process that has been followed at Kotak Mutual Fund, and I think at other mutual funds also. I'm sure that there must be a lot of insights that you all have gained out of that. The Future Ready panel, I think it's very encouraging to see the kind of statistics about how people are adapting to technology, adapting to digital, and using that as a tool of investment. And I think as an industry and all of us put together, I think we're all working towards bracing towards how we can make technology as a more better enabler. But I think some of the key inputs which came out of all panels was A, discipline, continuity in investments, stick to your long-term goals, stick to your financial goals, the reason and the objective for which the SIP has been done. I think we need to be sincere towards it and see to it that we adhere to that discipline of investing. So I think that should probably be the key takeaway out of this session that we've had today. And and thank you for participating, asking the panelists questions, keeping them on the check, and keeping this whole program very, very engaging with all of you all. So thank you once again on behalf of Kotak Mutual Fund and ET Now for being here with us today. Thank you very much.
I'd like to reiterate, you've been an incredibly well-informed, engaging audience, and we ask that you please join us for tea and refreshments. Have a lovely afternoon, and don't stop investing. Thank you.